Traders, and welcome to our 2020 Trading Success Summit. Great to see everybody here. We're joined by Tom Sosnoff, Larry McMillan, Steve Nissen, Harry Boxer, Barry Burns, and myself, Ken Calhoun. Great to see everyone here. We're going to start right away with Tom Sosnoff and get underway. Let me turn control over to you, Tom, and it's all yours.
Perfect. Can you see my screen, Ken?
Yeah, looks great.
Okay. And there's no, just confirming, there's no video of us, right?
Right.
Okay.
I mean, unless you want to.
No, it's totally fine. I didn't know what you were doing. You can, I'm not sure where that is on here, but beautiful. Okay.
You're good to go.
Thank you so much.
So anyway, well, I'm sorry, let me introduce Tom Sosnoff, CEO and founder of Tasty Trade. One of the smartest people in the whole industry, as are all my speakers today. Real pleasure to have Tom here. He's often a keynote speaker to standing room only crowds, the money show events, I know, and I'm a huge fan of Tom and his company, and highly recommend his YouTube channel, the #1, my favorite YouTube channel for traders in the world. And he's a brilliant man and a leader in the industry. And take it away, Tom Sosnoff. Thanks for being here.
Very nice. Nice introduction for a Saturday, rainy, cold Saturday morning here in Chicago. But
well, it's candid. You're worth it. You're the best. The best out there. So anyway, welcome aboard.
I'll take it. I need some. Everybody needs something positive, right, in the world right now. Anyway, so happy to be here, and I know people are still logging on. So, but I'm just going to get right into it. I only have 30 minutes, so I'm going to try to get as much done as we can in a 30-minute period. And I'm going to introduce you to, I don't know how many people on today know who I am or have any idea of kind of what our history is or why we're here. But basically, I've been on a mission for the last 20 years to introduce individual investors to, I shouldn't say introduce, I should say more or less engage individual investors in finance. And finance to me is a very broad term. Finance can include, really active trading. It can be just the transition from passive to active. I don't really care. What I do think is important is that in 2020 and then going forward for the next decade, you're going to see a very distinct change in the way individuals, self-direct investors. I mean, the nice thing about what we do is we only cater to self-directed individual traders. We don't do any business with institutions. We don't support any prop firms. We don't support any hedge funds or money managers or any managed products or anything like that. Tasty Trade and Tasty Works are all about supporting individual investors with content that they can become, that's quantitative content that will help you become more engaged in the strategic aspects of trading. So what I'm going to do here today is kind of give you just a 2-3 minute background and how we got where we are, and if we can say we're anywhere today, but how we got where we are, what we see kind of on the horizon for the next year, and then we'll spend the remainder of the time kind of walking you through the software and taking you to walking you through the software and really trying to give you a few takeaways, so that at the end of 30 minutes, there's something you can say, hey, you know what? That was pretty cool. I enjoyed that piece. I want to check out their software, or I want to, check out their content. However you want to think about it. I started this business in the early 80s, so I'm a dinosaur at this point. Been around the block a few times. I started off as a market maker. I spent almost 20 years, from 1980 to 1999, 2000, as a market maker on the floor of the CBOE. I traded primarily index products. I was, I guess, one of the survivors. We built a prop firm. We managed some money. We also had about 50 or so traders all over different exchange floors in Chicago. And in late 1999, we built a company called Thinkorswim. Thinkorswim was our first venture really outside into the retail side of the business. So we went from the market making side of the business to the to facilitating the customer side of the business. We just saw a very kind of dramatic change in the way orders were going to be routed and business was going to be done. And, you know, we guessed right, I guess. Anyway, so we built Thinkorswim in 1999 to 2000. We launched in late 2000, 2001. We were a public company. We got bought out in 2009 by TD Ameritrade. I stayed around for about 2 years to honor a contract, and then I went off and built Tasty Trade. With Tasty Trade, I felt like we wanted to do something different in the world of finance. We wanted to change financial content. And I didn't like what I saw on CNBC and Bloomberg and places like that, or different aspects of traditional investor education. I felt everything was too static. It was too guest related. It was too static. It wasn't strategic enough for me. So we built a quantitative network, which has now become the largest digital network in the world, digital financial network in the world. And we focus on using think tank research, which is all in-house done through data scientists, PhDs, just whoever, you know, whatever physicists, we hire smart mathematicians, and we try to break down and take strategic investing to a new level by building kind of a mechanical process where we optimize kind of what we're doing. And one of the things that Ken and I discussed today about what we would do during this, you know, this short period of time we have, is we would talk a little bit about, you know, some of the optimal pieces to mechanical investing. What that means is, and I can simplify it, it's kind of the concept of brains over bots. It's kind of the concept of trade small, trade often. It's really appreciating the fact that markets are random, and inside of random markets, there's an incredible amount of efficiency. You know, the comparison I like to make sometimes is when you think about sports betting and you think about just kind of, you know, how much money goes into sports betting, it's literally a fraction of 1% of what happens in the financial markets. I mean, it doesn't even come close to, you know, anywhere close to 100 basis points. I mean, we're talking about, you know, probably, I don't know, 8 or 9 basis points total of the amount of money that's notionally traded in sports gambling as compared to liquid, efficient financial markets. Why that's important is because the bid-ask differential and the spread in order to be strategic in the world of gambling is ridiculously wide. You used to say you could drive a truck through it. Well, you can drive a country through it. In some cases, it's up to 10%. In the world of finance, we're talking about stocks like, for example, you know, Amazon, which is a $3,500 or $3,100 stock, where you can do a defined risk spread, 1 penny around theoretical, or you can do a trade in Apple, or you can do a trade in Netflix or Tesla, just as an example, with 1 or 2 pennies around theoretical, which is basically a give up of less than, you know, 2 or 3 basis points. When you start to think about that and compare that to 10,000 basis points in give up in sports gambling, you wonder why so much money and so much notional flow goes through the listed financial markets, and why it's so cool to have at your fingertips some strategic knowledge that also optimizes the math. The reason it's so important is because it's in 2020, there is no kind of traditional edge. The edge today is a mechanical edge. The edge today is your know-how. The edge today is being able to pick and choose what you want to do and when you want to do it. The edge today is being able to know when you have small advantages on your side that give you the opportunity to do things, for example, like manage winners, like take advantage of fear, like take advantage of being able to be product indifferent. One of the things that I'm going to start off with today is the concept of product indifference, because it's so cool. When we were going back just 20 years ago, that's how fast time moves now. 20 years ago, it was impossible to trade multiple products from a single platform because the marketplace access wasn't there. Starting in the 2000s, and we were the leaders in this case, we built technology that now drives almost 50% of all the retail volume that takes place in the options marketplace, which is the fastest growing marketplace and has been for almost the last 2 decades. And one of the things that we've done is we've democratized it, or an easier way to say is we've commoditized it by creating technology that doesn't care what you trade. So whether you want to trade an S&P 500 future you want to trade soybeans or natural gas, or you want to trade Tesla or IBM or some new IPO, or you wanted to even trade, a digital asset like Bitcoin or Ethereum, whatever else it is, it doesn't matter anymore, because the pricing models that are used to determine theoretical value are virtually all the same, and the technology that we route order flow with today is completely the same. So the cool thing about Tastyworks, and I should give you just a little bit of background. We built Tasty Trade, which is our network, in 2011. We launched at the middle of 2011, and that was 9.5 years ago. We launched Tastyworks in 2017. Tastyworks is a follow-up to our Thinkorswim platform that we launched in 2000. Tastyworks is the most advanced piece of customer-facing technology in the marketplace today. Tastyworks is a trading platform. It's free. Everything I do is free, by the way. We don't except for the small commissions on options and futures. That's it. Everything else, our technology, our content, everything we do is free. So we don't sell anything. We just ask that, hey, you use our stuff, you use our great content or our research and everything else. Hopefully you'll trade on our platform. And that's all we ask. And we built a platform that the middle piece of it, the middleware piece, is all built on high frequency technology. So the middle piece of middleware of Tastyworks is the fastest platform in the world. It basically routes at about 25 milliseconds, which is up to 30 or 40 times faster than traditional legacy online brokers. Does that really help you? No, not like it's not noticeable. The difference, in an eye blink is not that important. But what it means is you're never going to be disadvantaged using the Tastyworks platform. It's also far more stable than some of the new platforms out there, or like some of the new free platforms out there. Sometimes you can't afford free, and also like some of the legacy platforms that are having trouble, and they're bogging down on all the order flow and all the data that now goes to platforms. Tastyworks is optimized for speed and stability. And the cool thing about Tastyworks, and I'm showing you the entire platform is right in front of you right now. The left-hand gutter is a market watch. That's it. And you can set this up however you want. And there are gazillions of choices. There are different sectors. There are different presets. You can see your positions. You can save anything you want. I mean, there's literally hundreds of different default menus. Well, the reason that's so important is because what we've done on this platform is we've made it so that it's been optimized for simplicity. Even though it handles any kind of complexity with respect to strategic investing, it is built and optimized for simplicity. Let me give you an example. If you want to trade S&P futures, you just click on the ask price in a watch list. If you decided, hey, you know what, I want to trade soybean futures, you just click on the ask price. And what happens is soybean futures pop in here, soybean futures pop up here, soybean options pop here, a soybean chart pops here, your soybean position pops over here. I currently don't have one in this account. And all your activity in soybeans, if you wanted to see soybeans, would pop in here. Like, for example, if I wanted to see, just to show you, if I wanted to say, forget soybeans, but I wanted to see 10-year notes. So here's an example where, I can see a chart of 10-year notes here. They don't move much. I can see my position here. I can see all the 10-year notes I made over the last trades I made over the last 7 days. I can see all the options in here for 10-year notes. I can see all the Greeks and all the theoreticals around doing any 10-year note trade, and I can see the 10-year notes up here at the top. If I want to buy them, I just click on the offer. If I want to sell them, I just click on the bid. That's all there is to the entire platform. If I want to trade an option in 10-year notes, I just open up Jan, for example. If I want to sell a put, just hit the bid. If I want to sell a call, if I want to sell a call, just hit the bid, and that's a short strangle. If I wanted to, and I'm going to go through this fast because I don't have a lot of time. If I wanted to make this into a classic J Lizard, just do this. Notice how I didn't click on anything or type anything in. This is not an old school legacy platform where you have millions of different things you have to choose and type. This is drag, drop, click. That's it. Now, instead, I'll clear this up and show you. This is bonds. Let's say I wanted to look at Bitcoin. Boom, here's Bitcoin, same thing. Let's say I wanted to look at Tesla. Here's Tesla, same exact thing. Here's a chart of Tesla. Here's my Tesla position. Here's all the Tesla trades I made. Here's all Tesla option layout. It doesn't care. This platform does not care what you trade. It doesn't care if you buy, if you're buying or selling Tesla. It doesn't care if you're buying or selling soybeans. It doesn't care if you're buying or selling S&Ps. We don't limit you, okay? We don't limit you at all to what you can trade product-wise or what you can trade strategy-wise. Unlike some of the other legacy brokers where you have to, quote, be suitable to trade complex strategy or be suitable to have, or have a certain amount of money to do a certain type of trade, we let anybody do any trade that they want as long as you have the capital to do that trade. So there's no levels, there's no requirements in the traditional sense. We also don't limit you to what you can do like other firms do. If you want to sell a naked call in an IRA account, go ahead. If you want to sell a naked put on soybeans in an IRA account, go ahead. We don't care. We let you do whatever you want, regardless of account type, regardless of the amount of money you have, regardless of what other people tell you you're qualified for. Because the complexity of a trade has nothing to do with the risk of a trade. Absolutely zero. Anyway, let me quickly go through and just show you some stuff in here, because again, I only have a short period of time today, and what I want to do to really get as many people in, to bring as much information as I can to as many people as possible in a short period of time, is just engage you enough to get you excited about checking out the Tastyworks platform. There's a reason this platform is the fastest growing platform in the world right now for active traders. Average person on this platform trades about 1,200 times a year. The average person before they get to this platform trades like about 180 or 170 times a year. So it's a combination of capped commissions, it's a combination of the simplicity, it's a combination of the stability of the platform, and it's a combination of the way we've designed our content and our platform to basically encourage you to trade small and trade often. Let me explain a little bit what that means. What we believe is the key to success for retail investors is to stop trying to hit, a home run, or stop trying to think what's going to happen next. What we believe the key for retail investors is to understand, the math, understand kind of how math works with respect to strategic investing. So I'm going to put Tesla up here. I know it's a $600 stock, but I have it already on the list. I have a bunch of different Tesla positions, as you can see over here, just a couple little things. And but what I want to show you in Tesla, what's interesting, because it's going into the S&P and on December 21st, so it's definitely a stock that's in play. I mean, it traded 46 million shares on Friday. It has a very high IV rank. So the first thing we show you on the Tastyworks platform, so that you can give context to whether a specific underlying is really interesting. And remember, this is a high-level discussion today. I did not prepare this for beginners. I prepared this for people that are into trading, that are active traders. But I believe it applies to everybody. I don't do things that apply to just a few people. I believe this applies to everybody. So if I said to you, hey, is Tesla ripe for trading? You'd be like, well, what makes a stock ripe for trading? Is it based on price? No, it's based on where the fear and uncertainty in that particular stock price out the various option contracts. So with an IV rank of 40, which means on a scale of 0 to 100, this is at 41. That means it's a pretty rich implied volatility. That means this 98% implied volatility in Tesla is very expensive. What it also means is, and you can see over here that based on this 98% implied volatility in Tesla, the expected move in Tesla over the course of the next 34 days is $132. That's just math, okay? If you have an efficient market, and in that efficient market, you have the various variables that you can just pull out, you can create a really interesting model, and you can tell people what the expected move is, higher or lower. It's $132 for the next 34 days based on a 98% volatility. And if we were going to go open, let's just say we were going to go out and we were going to open January options, and we were, again, I'll take you through a process. Let's say at first we wanted to do something like, hey, you know what? Premium's so rich in here, and the stock is $609 where it closed. So with an expected move of $132, let's say I wanted to go just outside the expected move. So I wanted to go and sell the 480 puts, that's $130 lower. Or I wanted to sell on the call side, let's just say I wanted to sell the 740 calls. That's $180 lower. It's $130 higher. So let's just say I wanted to start off with a strangle where I had the potential to collect $47. Now that's an expensive strangle because you have to put up about 20% of the price of the underlying, or about $12,000 to trade, one strangle. So what's interesting about that is what we call, there's a lot of product diversification here. Tesla, which has been highly correlated to the NASDAQ, it's been highly correlated actually to the Russell as well, and it's obviously had a crazy explosive move. So it has a very high correlation to the S&Ps. It has a very high beta, it has a very high implied volatility, and it has very rich premium. So it's not the worst use of $12,000 to sell a very high probability strategy. Well, how high probability strategy is it? Well, since we went to about the 16 delta on both sides, it has a pop. See, I'm on the same page still, which is really cool. It has a pop of 68%. That is probability of profit of 68%. It has the amount of extrinsic premium you collect on a one lot is $4,700. So wow, you can make $4,700 if this expires worthless, with a 68% theoretical probability of profit of making 1 penny, but an 82% probability of making 50% of max profit, which is even more impressive. We call that's a Monte Carlo simulation that's based off of the probability of making 50%. P50 is a proprietary number built inside the Tastyworks platform. You can see the delta on this trade is really small. It's only short 13 shares of Tesla. And again, this is very interesting because all your Greeks are right on the same page. If you wanted to say, hey, you know what, that's cool, but let me see a chart, there's a chart. If you want to throw any indicator or anything you want in here, that's fine. If you want to see another chart of Tesla and compare it, you can just move. We have multiple charting platforms in here. If you wanted to see what any of the Tasty Trade team is doing in Tesla, you can do that too. And you can see what every one of us has done in Tesla by just doing a symbol filter here, and you can see all of our trades in Tesla. And this would be my trades included, along with everybody else at Tasty that's been trading Tesla. Also, which is really cool. We have a follow page. Also, if you wanted to say, hey, you know what, that's cool, but I'd actually like to see some more research on Tesla, hey, you can watch it. Right now, we're actually doing a live research show with Anton and Julia that's broadcast on Saturdays, but here's all the research we've done, and you can actually search by Tesla and stuff like that. And this is all built into the platform. And if you've noticed, this is all on the exact same page, and it's all free. And taking you back to Tesla for a second, going back to these January options, let's say, you know what, it's cool, but this is too much of a reach for me because I don't want to put up, $10,000 or $12,000 to sell a naked strangle. So instead, I'm going to do it. I'm going to buy the wings. And remember, I'm not typing in anything here. I'm going to buy the wings $20 wide. And now I'm going to do an iron condor. And I'm going to collect a little over 1/3 the width of the strikes, $20 wide. 1/3 the width of the strikes is just under $7. It would be $6.67, but $7.50. So I can, again, adjust this trade and require $750 minus $20 or $1,250 in buying power reduction. So I went from just under 12,000 to just over 1,200, and by just making it an iron condor. If I wanted to make it even a smaller iron condor, I can go $10 wide by just dragging the strikes. Now I collect $3.90. This was rounded up to $4, and say on $10 wide, I'm only putting up $600. So what I showed you without actually typing in anything on this platform was that you can type in Tesla, you can see if it's a viable trade candidate as a portfolio diversification with high implied volatility rank with a huge return on capital. And I showed you an undefined risk trade that would require, probably around $10,000 in capital, just under 20% of the strike price, taking it down to a $20 wide iron condor, and then taking it down to a $10 wide iron condor. So going from $10,000 to $1,200 to $600 use in capital. And that's the beauty of strategic investing, is to enable yourself to be capital efficient. The next decade, from 2020, we're almost at the end of it now, but from 2021 to 2030 is going to be the decade of capital efficiency. You are going to have to understand how to use capital efficiency in order to be a successful trader. Hold on, I'm going to show you something else here. I'm going to move these strikes much, much closer, just because I want to give you an example here. This is a $10 wide iron condor. It's actually a little bit too tight for us, but I want to show you quickly on here that we also have a curve mode. So you can bring, if you're a very visual person, you can actually, for those of you that prefer to see things, inside of a distribution curve, you can see it on the Tastyworks platform multiple ways. We call this a curve mode. So you can see the order that you're about to route, and you can adjust the strikes if you want to. If you want to widen it out a little bit, you can adjust the strikes. If you want to widen this out, you can adjust the strikes. Where it's green is where you make money, where it's red is where you lose money. This is the distribution curve. It should be a little asymmetrical, but that's your distribution curve. All your Greeks and all the same Greek metrics are down here at the bottom of the page. And then you can see, again, your IV rank and everything, and then your order is right here. That's how simple this platform is. And if you wanted to go check it out on a chart, you have a chart up here in this, which is configurable up in the right-hand corner. You also have a chart here, which you can go see. If you wanted a bigger one, you can detach that. You can see all your Tesla positions here. You can see all your Tesla orders here, and you can see what's happening in the rest of the market here. There is no other platform in the world like this. And it's lightning fast, and it's crazy stable. We've had virtually zero downtime in 3.5 years. So you have a stable platform that's fast, that routes to any marketplace, that shows you your orders in either a curve mode, an active trader mode, a grid mode, a pairs mode, or the classic table mode. Doesn't matter to us. You can do it, you can route from any mode you like, and you can use all of the content that's in here. And again, it's all crazy free. And even better, we cap the max commission at $10. So if you wanted to trade, for example, if you wanted to trade, I'll just give you here, I'll show you this for one quick second, just to make it simple. I know you're not going to do this, but if you wanted to trade 100, I'll use a cheaper stock because it'll make more sense. So I'll use US Steel. Let's say in US Steel, because it's only an $18 stock, let's say you wanted to sell a 50 lot of puts. We only charge you $10 and $0 to close. So that's all you pay is $10 to open, $0 to close. Let's say you want to sell 100 lot of puts, $10. 1,000 lot, $10. That's all it is, and $0 to close. If you wanted to trade one option, it's $1, $0 to close. If you wanted to do this spread, and you want to do this spread 20 times, it's only $10 a leg. That's the max you can ever pay per leg is $10 on Tasty Trade. If you want to do 100 of these spreads, you only pay $10 a leg, $0 to close. So not only is it the fastest and most stable platform, it's also the least expensive. I mean, there are some platforms that are free, but those platforms are untradeable. I mean, you can do very basic stuff and you'll be frustrated. Like we say, you can't afford free. There is no platform that has the technological and optimization power of Tastyworks and the low cost and the stability. It's really an amazing job done by some incredible developers, and I'm just lucky to be a part of that team. In addition to that, what Tastyworks lets you do is it lets you trade. If you wanted to trade and you had US Steel and you wanted to put US Steel next to Tesla and you wanted to put Tesla next to soybeans and you wanted to put soybeans next to bonds and you wanted to put bonds next to Bitcoin, you do it all from a single account. And regardless of the type of account you have, whether it's portfolio margin, whether it's regular individual margin, whether it's an IRA account, you can do the same thing in any account, doesn't make a difference, and trade anything you like. I threw a lot of stuff at you in a very, very short period of time, in 28 minutes. I hope it's not overwhelming, but let me give you the good news. We also are incredible at support, and I don't think there's any firm like us when it comes to supporting the customer and really, I don't mean just support like, just answering emails and things like that. I mean supporting you with research, not subjective stuff, but quantitative mathematical research. And we do heavy research too. So I think you're going to love it. If you're smart and you like to be intellectually challenged and you think, hey, this is a industry that I'm passionate about, that I love, it's got some really cool upside for me personally, yeah, then check out Tasty Trade, our digital network, and check out Tastyworks, our platform. And if you have any questions, or this is something that you want to, dig deeper in, or you want to, nothing's off limits with me. So ask me anything you want. My email is tom@tastytrade.com. It's just tom@tastytrade.com. And you can ask us anything. We have an incredible Learn Center on the Tasty Trade website. And it's simple to download the Tastyworks platform. It's clean, it's light, it's not heavy like other platforms. We have mobile, we have web-based, we have everything. And there's a reason why, why it's such a popular platform. So check out our stuff and have a great weekend, everybody. Enjoy the other speakers and be safe and be smart, be safe, and reach out to me, Tom at Tasty Trade, if you have any questions or you want some follow-up. And again, nothing's off limits. Thank you so much.
Well, thanks a million, Tom Sosnov. You are brilliant, sir, and this is by far and away the world's best platform, like hands down. It's like the gold standard. It's no comparison between you and everyone else out there. So if you're an options trader, you've got to join Tastyworks. Thanks, Tom Sosnov. I appreciate you for being here. Thanks so much.
Thanks, Ken. Appreciate it. Thanks for having me.
Thanks. Now, next up, we've got my longtime colleague, Steve Nissen. We've worked together for 20 years. Let me switch over to Steve, and we are getting ready to go. And again, traders, thanks to all of you for being here. We do not have time for Q&A because of our tight time frame. So let's switch over to Steve Nissen, and we'll get underway.
Great, thanks, Ken. And it's a real pleasure working with you once again.
Once again.
Yeah, 20 years, God, you make me feel old. So,
Me too.
So anyway, what we're going to be doing here is a way to increase the potential success with candlesticks. You notice the title, East plus West for increased confidence. Many of you are familiar with candles, I'm assuming, but many traders and investors don't use candles the most powerful way, and that is by adding Western technicals. So I'm really excited to be here for Ken and doing the presentation for the World's Top Traders Summit. I'm just one of many top tier traders, so an educator, so it's a real pleasure being here. To start with our caveat, and you will be tested on this, so I expect everybody to read this. But the main point is that, as you should know, that there's a risk of loss of trading in pretty much in any market. So if you want to see the whole risk disclosure, you can go to this link here, shown at the bottom of the slide. And just a reminder, the benefit of candlesticks, I just normally refer to them as candles. They're very easy to understand. My assumption is that you are familiar with candlesticks already, so I really don't have to go over the construction. They're really good also for safety first trading. One of the most important aspects of successful trading is knowing what not to do, risk avoidance. So there are times that you should know not to enter the market, and candles are great for doing that. They work in all markets and all time frames. We at candletrust.com have clients from over 85 countries, and that's because of the universality of candles, no matter what market, no matter what time frame. And the main thrust of candles, the reason they are so popular since I revealed them in the 1980s, they give you turning signals well ahead of traditional Western technicals. But that doesn't mean you should not use Western technicals. And by Western technicals, I mean whatever Western technicals you are most comfortable with, moving averages, trend lines, Fibonacci retracements. This short seminar is really focused on just reminding you to add that to your current arsenal of using candlesticks. There's a Japanese proverb that says, "He whose ranks are united in purpose will be victorious." I guess in this moment we would say he or she. And the idea behind this is uniting Eastern, that is candlestick charting techniques, with Western charting techniques. And we call this the multiplier effect, where a candle signal, and the reason we call it a Nissen candle signal is because there's so much candlestick education out there. Unfortunately, most of it is not very good. So when you learn from us at candletrust.com, you're going to the main source of candlestick education, and you're learning how to use candles and in combination with Western technicals correctly. So we just happen to call it a Nissen candle signal. But where a candlestick signal confirms another indicator. I'll show you some of the indicators that I like using in Western technicals, but there are so many Western indicators that you probably are a specialist in one or two of them. So whatever I show here, for example, I just like horizontal resistance and support areas, but if you're an expert in stochastics or Fibonacci retracements, and you have a candlestick signal confirming one of your favorite Western indicators, and you know all the nuances of the Western indicator, that's when I would become more aggressive on a trade. And just to give you a little background of the importance of Western technicals, not only to us in the West, you know, since we've been using them for many, many years, even before I revealed candles, but for those in Japan. What we have here is some of the Japanese books I had translated. This is why it took me over a year to do the research on the candlesticks. So these are just some of the Japanese books. Luckily, I found the translator and the binder here with the blue arrow. These are all the pages in English, believe it or not, that were translated from these books. And these little tabs, you know, are just a way of organized everything. But what was really interesting is that in almost all these Japanese books, they had Western technicals. So for example, here is a cover of one of the books. And I don't speak Japanese, so I had to write down what the name was so I could reference it in my binder. But this is a perfect example. You could see the author here used moving averages, as I do, and candlesticks. And the Japanese have been using Western technicals. They use the best of our techniques. And when I revealed the candles, we knew then how to use the best of their techniques. And let me show you why it's so important to understand adding candlesticks to your overlay, Western technicals to your overlay of candle signals. Okay, a few years ago, I got this from a trader, and this is a shooting star. Okay, you notice the title of the slide, How Not to Use Candlesticks, but there's a classic shooting star. So he told me that he went short on the shooting star, and the market rallied right after the shooting star. And he said, oh my goodness, candles don't work and so forth. And I said, first of all, candles are not 100%. But I said, you missed something really, really important. Yes, the market rallied after the shooting star, but what is the shooting star confirming? Okay. A resistance area. So he actually, you know, got out over here. He was nervous, and he got out at exactly the wrong time because, okay, this is what happened after. And by the way, a little bit more advanced, as an aside, if you are selling, let's say you're shorting on a shooting star, you should be willing to have a protective stop above the high of the shooting star. You shouldn't think that just because there's a bearish signal, the market is not going to rally. All right, so but we'll be looking at more of this concept, because actually, if there's a breakout above a bearish candle signal, that could be a momentum trade. In other words, it's time to figure out if it's time to go long. Now, if you think about it, candles give you twice the information of the bar chart, and that's why everybody, all the charting services now, which is amazing, you know, because up until my first book came out in late 80s or 1990, and so every charting system in the West used bar charts, but now every charting system in the West uses candles, and that's because you don't give up any information with a candlestick chart. The candles obviously use the open, high, low, and close, and what does the bar chart use? Yeah, same thing, open, high, low, and close. But the main difference, and the reason that Japanese shifted over to candles generations ago, was because the candles show the force of the move. And you know, many of you, I'm sure, are aware of this, but I think it's important to kind of give you the foundation of this before we delve into candles and Western technicals. So over here with a green or white real body, depending on your charting platform, okay, who's in charge? Remember, with a green candle, the market closed here. It doesn't matter the time frame. It could be weekly or daily. The market opened here and closed here. Obviously, the bulls are in charge. Over here, the bears are in charge. And on the right side is a doji, with the opening and closing are the same. And who's in control of the doji? Nobody, right? There's an equilibrium of forces. And let me dissuade you from one of the common misuses of candles, especially a doji. People see a doji during the rally and they think it's bearish. It's really not. It turns the trend from up to neutral. That does increase the likelihood of a reversal, but it's not a strong bearish signal like a bearish engulfing pattern or a dark cloud cover. But anyway, so it's the same data as the bar chart, open, high, low, and close, but we're getting a sense of the force of the move based on the candlestick signal. Okay, now what we could use this information about, read the force of the market, whether it's the bulls or the bears or there's an equilibrium, is seeing how solid support or resistance is. I had this cartoon made up. Boy, this one has a weak foundation. Thank goodness for expert advice. Now, how can we tell if there's a strong foundation or a strong resistance area? And, you know, Tom just spoke before me about options. Keep in mind, this is really important for options because you'd be more aggressive on an option trade if you have increased confidence about the solidity of support or resistance. So, but before we do that, let me show you. Okay, one of my trading principles is that not all candlestick signals are equal. So what we could do is analyze the candlestick line at support or resistance. So getting back to this idea of the doji, remember where the market's in equilibrium between the bulls and the bears. Okay, here we have the market in a box range. Let's say, you know, this is support and resistance. We have a doji in the middle of a trading range. Is there something different about the market based on the doji? Obviously not, right? Okay, there's a box range, Japanese collateral box range, lateral trading environment, a box range. Okay, so I wouldn't place much emphasis on the doji, but let's have the doji over here. Is that telling you something? You bet it is. So here we have a doji confirming just a classic Western signal, a horizontal resistance area. Then you could be more aggressive on that particular bearish trade. You know, so, you know, maybe you do an outright put instead of a spread or something like that. And of course, depending on your risk tolerance, I would have a protective stop above this resistance area. Now, one of the tricks is to help determine what I call candle confirmation. In other words, if we're getting a candle signal confirming a support or resistance area, I call that candle confirmation. All right. And with that in mind, is the candle signal showing a diminution or a slowing of force at a support or resistance area? And this is how we can tell how solid support or potential support or resistance is. And the way we do this is really just very simple. You ask two simple questions. One, I just mentioned, is the market at support or resistance? And the key is, and this is why it's so important to correctly understand candlestick signals, are there any reversal candles? So let's look at this. Okay. Here we have a falling window on the left. Okay, a falling window is the same as a gap. Okay, and actually, sorry, the window is actually between here and here. This blue line should be down here. Okay, over here, this whole window, this whole gap. And the top of the falling window is the key resistance area. Okay, and we also had a shooting star over here. But although the market pushed above the top of the window, it didn't close above it. So that falling window is still resistance. So now we ask, the market's at the resistance area, you know, near the top. And again, this blue line should be down here. But we're really concerned about this top blue line, okay, as the key resistance area. When we ask the two questions, question one, is the market near resistance? Okay, we all should be saying yes. Question two, remember the two questions, are there any reversal candles on here? And the answer is no. This is a strong real body. Okay, remember, depending on your charting platform, it could be a white real body or a green real body. The close is over here. So I'd be very nervous about trying to put on a bear position. Maybe I'd lighten up a little bit on a long position, but being more aggressive, we don't have that confirmation all of the candles. Same thing here. Ask two questions. Is the market at resistance? Yes. Second question, are there any signals a lot of the candles telling us the market's losing momentum? Indeed. Okay, we have almost a doji, small real body. For those a little bit more expertise, this is actually a bear hammering. So here's where you can become more aggressive on a bear trade, okay, with the stop above the falling window, okay, candle confirmation. here again, and I just did, you know, different markets. A lot of them we don't even have dates on it because it really doesn't matter, or sometimes you don't have the markets. This happened to be bonds, and here there's a classic bearish engulfing pattern. But even if you didn't know this as a bearish candlestick signal, we would have this as a resistance area in a bar chart, right? Prior highs. Look at this, markets at resistance, a doji. The doji is confirming a resistance area around 175.5. Okay, that's where we become a little bit more aggressive on the bearish side, or we could take long. So we could use bearish candlestick signals, especially at resistance, you know, not only to think about shorting, which is a little difficult to do in equities, but certainly easy to do with options and Forex, but think about lightening up on long positions. Same thing here, okay, your euro, okay, resistance zone. Markets at resistance, yeah. Any bearish signals or signs the bulls are losing steam on this first blue arrow? Indeed. Okay, a doji. And then as though you needed extra confirmation, a bearish engulfing pattern. And because this is a Forex, you know, this is something you may want to think about shorting because of the ease of shorting in the Forex market. So I personally like using horizontal support and resistance. It's very clean, it's very easy. You can see it doesn't have to be exactly a prior high. If we have two highs, even separated by a little bit near each other, I'll make a resistance zone. Okay, on the flip side, here, the green candle wrapping around the red real body, classic bullish engulfing pattern. No real bottom reversal signals here. This is almost a bullish hottomy, but you know, that's not a strong reversal. But barring that, you could see that the bulls were able to maintain control anywhere around 190, 129.60, 129.70, and we get the final bullish confirmation with this bullish engulfing pattern. Now, normally the low of a candlestick signal should be a support area and hence a stop out area. But again, when, you know, as I see things, I'll give you a little bit more advanced nuance. If we bought on this bullish engulfing pattern, okay, I would not have the stop at 129.60. I would have the protective stop on a long under here. Why? Because wouldn't it be upsetting? The market moves under the low of the bullish engulfing pattern where you were thinking of having a stop and holds the lows here. So if we have a bullish candlestick signal low, like here next to a prior low, I would give it a little bit more leeway to the prior low. Here to actually make a support zone. Okay. Now I mentioned before momentum trading. That's trading on a breakout. And we looked at having candlestick signals, whether a doji or bearish engulfing pattern, whatever, confirming a resistance area. And remember, the flip side could be a support area. Let's say the market's selling off and there's support, and then there's a bullish hammer or a bullish engulfing pattern. That increases the likelihood of that support holding. And since we could use candle signals as support or resistance, what that means is if the market can break above a candlestick resistance area, one can think about going long, a momentum breakout. And I really like those because a lot of times you're going with the major trend. So let's look at an example of that. Okay, so here we have on this first red arrow, okay, euro. This might be, I'm not sure if this is an intraday or not, but anyway, there's a doji, okay, and you can see the highs over here, high over here, and the high over here with the doji, and over here. So to me, this doji is confirming a resistance area, and one can think about shorting here, and no reason not to, okay? But if you do short here, where do you set a stop? On a move above this resistance area, especially the doji. So if you were short, you would be stopped out over here. But let's say you were bullish on the euro, this is the euro US. Let's say you were bullish and you were waiting for the market to break a resistance area. This would be a great time to think about buying on the breakout above this resistance area. All right, so this would be a momentum trade over here. Now over here, okay, we have the doji, and you could use the high of the doji even if it doesn't confirm resistance, sometimes as a resistance area. So here we have a doji and this prior high. So you could take these two highs, and that becomes a resistance level. If the market breaks above that, that's a momentum trade. But you could see session after session, it's stalled there in this zone. Get a bearish engulfing pattern, another little bearish engulfing pattern. So this might be a good time to actually consider shorting. There's that breakout. Okay, one of the strategies I like using is a crack and snap. The market breaks under support and then gets back under the support area. Okay, you could buy it on the breakout, and your target is the most recent high. So here, there's a support level. Market breaks under it. See on the session here? Okay, there was a bullish engulfing pattern here and a piercing pattern here. Market breaks under it. As soon as it gets back above that broken support area, you can think about buying with a protective stop under the low here and a target, a minimum target to the most recent high. Okay, this is a strategy I use a lot. Okay. Flip side is falling off the roof. Okay, the Japanese, these are really false breakouts. We have a resistance area tested at least twice. The market gets above it. And in theory, if the market breaks above resistance, this old resistance should be support. So the market breaks above it, gets back under it. You could think about shorting there. And the reason the Japanese call it falling off the roof is because there's a Japanese proverb that says, let him climb the roof and then take away the ladder. You could sell it here, short it here, keep a protective stop above the high, and your target is the most recent low. So here we have a falling off the roof and candles and context. The market closed above this resistance area here on the first blue arrow. Now here we have a doji. It's also a shooting star. But why aren't we, when we look at candles, we have to look at candles in context. Although there's a doji, this is still holding the high close very well. To me, to be bearish, okay, I would want to see a close back under this old resistance area, falling off the roof, and that occurred over here. So just because you have a doji, especially if it's a new high for the move, okay, you have to consider that yes, it's a doji, market's a little bit more neutral, but the bulls are still in charge. You have to wait at a minimum for a close under the doji's close, or in this case, under the prior resistance area. Here's another falling off the roof. Okay. Now, candles don't give price targets, and this is why it's so important also to use Western technicals. I have this cartoon. I have a cartoonist made up, so I don't have to worry about copyrights. I can tell you how, I can't tell you how far it is, but I do know it's that way. Okay, so here, east and west. Okay, what two signals warrant caution? Okay, one is the bearish engulfing pattern. Two, look, it's at a resistance area, east plus west. And for those who look at Bollinger Bands, it's also at the top of the Bollinger Band. The stop, where the stop be, if you're shorting, above the high here. And where is a potential target? Okay, this is why I love box ranges. See, support, resistance, a box range. Very often, if you start at the top end of the box range, you're going to come back to the bottom end of the box range. And that's what happened. Okay. Excuse me. So in the first one, we saw you could use a box range to get a target to the downside or the upside if the market has a bullish signal here and rallies. But you could also use targets, box range breakouts. So if the market's in a lateral trading range, if it breaks out, you can take the height of the trading range. And once again, this is why I add Western technicals to candles. You take the height of the range and add it to the breakout. Or if the market breaks under a multi-tested support area, you take the breakout and add it downside. So over here, gold, classic box range. So something like this is a zone, so I take the middle of the zone. So you have about a $200 box range. You add 200 to 1350, and you get a target to 1550. Classic box range breakout. I view this as kind of like a coiled spring, and once it breaks out, you're releasing the tension of the spring. Okay. And one of my strategies is change of polarity. Old resistance becomes support. I don't have time to get into that now. It's one of my favorites. I'll tell you in a couple of minutes how you can find out about that strategy. Here, long-term breakout in Tesla. It doesn't mean it's going to tell you exactly how high it's going to go. It gives you a minimum target. You see this on a weekly chart. And so, this is pre-split, but this is the height of the box range. This gives you a minimum target. It doesn't tell you where the market's going to stop. It just gives you a minimum target. And you can see here, it's a little hard. See this old resistance area where my pointer is now? See how that became support? So if the market does break above the top end of the box range, it should not get back under it again. You could also use volume. Okay, here's a bullish engulfing pattern. And you see there's higher volume on the white candle than there is on the black candle. Okay. Now we looked at candles and Western technicals. I wanted to also very briefly, in just 2 or 3 minutes, go over trade management, a very important rule, risk reward. Okay, even if a candle signal confirms a Western signal, doesn't mean you do a trade. You always have to think about the risk reward. So for example, here we have a classic bearish engulfing pattern where the black real body wraps around a small white real body. Again, this might be red in your charting system and green here, and a shooting star. And which would be a better trading signal? Let's say these are, both confirming resistance. Which would be a better trading signal? And this brings out the aspect about the risk reward. You don't know, because we have to look at the risk reward. So here we have a classic bearish engulfing pattern, right? But by the time you get the signal, it's all the way down here. So if you're shorting, your stop is up here. And in other words, your risk is here and your target is here. That is a bad risk reward. Whereas here with the shooting star of the doji, you have 2 things. One, it's confirming resistance, right? But more importantly, with the shooting star, if you shorted here, your stop would be above the high here, and your target, my target wouldn't be here, it'd be the sorry, below the most recent low, which would be over here. Is that a good risk reward? Yes. So we wait for time to ripen, although even if you have, like I said, a candle signal, even if this bearish engulfing pattern confirmed a Western signal, wouldn't do a trade with this because of the poor risk reward as compared to this over here. So let me wrap it up here. Let me give you, because we're getting requests for more information. If you go to this link here, candlecharts.com /express, we have a new video. It's instantly available. It's streaming. And what that does is take some of my favorite strategies, including quite a few that we haven't had time to discuss here. And very quickly, I think it's a 3.5-hour video, and you can break it up however you want. You watch a half an hour or an hour or whatever. And it's a great way to get the best strategies, East and West, candles, trade management, and so forth. A lot of great bonuses. Okay, reference checklists, handouts, chart challenges. People love this. I show a slide and I say, what would you do here? Why? What candle signals do you see? And so forth. So if you go to this link over here, you'll see a 5-minute video giving you all the basics. What we've done as a kind of a thank you to Ken and for those who attended the session is you're going to save an extra $50. Use this coupon, secret coupon, $50. When you check out, you'll be able to get this instead of $149. You'll be able to get this for $99. Normally it would be $295. On our website, we normally have it for $149 as a special price from time to time, but you'll be able to get this for $99. This will expire this Monday. Now, if there's any questions, contact Paul at candlecharts.com. And before I leave, as promised in the description, we are going to do a raffle, and the raffle will be for this great educational experience, the Express class. And since I don't have access to the attendees, can you kind of randomly pick somebody from the attendee list?
Sure. How about Mike Sun? I'm sorry, Mike S. Mike S.
Okay, Mike, if you could, thank you, Ken. Mike, if you could email Paul at candlecharts.com, and he'll give you the link and all your bonuses just for attending this course. So I want to thank you for joining me. As always, it's a pleasure working with Ken. He has top tier traders working with him, and I'm really complimented that they even thought of me in his very, very select group. So over to you, Ken, and enjoy the rest of the session, everybody.
Hey, thanks. It's a brilliant presentation. Steve, in quick 60 seconds, can you run back to that first chart that had the shooting star where the guy got out too early?
Oh,
This is
yeah.
Earlier than this one, earlier than that.
Yeah.
It's
No,
like
no, with the first one. So
traders,
it's like a time machine. We're going backwards.
Yeah, no.
Yeah.
How to take profits. Some of my best real money winning trades, most
Here we
of them
go.
have been, okay.
That one? Yeah.
Right, exactly right. How to take profits. And this I learned
Mhm.
from you, Steve. Some of my best winning real money trades have been based on this. And I learned this from you, when price gets under the shooting star low, say if you're in a winning swing trade, a break under that support line is where to sell, or at least lighten up on your trade. And I've made so much money with that with my winning trade. So I learned that from you, Steve. When you
Glad to
see
hear.
the loss of a shooting star in an uptrend, that's where to at least start scaling out, if not go to cash. And that's how to lock in profits. For example, we have a bearish engulfing in the S&P here last week. But anyway, when you see that, that's a great place to exit your trades if you're in the money in a trade before it rolls over. So thanks, Steve, for that, and
Great.
for all the rest of the content today. It's brilliant.
Great. Okay, great. Thanks, Ken. And again, thanks to you, everybody, for joining me. Okay.
All right, thanks. And next up, we're going to have Harry Boxer. So let me turn over to Harry. Thanks, Steve Dissett. He's brilliant. And so many people screw up the candlestick education except Steve. So make sure you learn exclusively from Steve Nissen how to trade candles. Everybody else is a pale imitation. Let's flip over to Harry Boxer. Thanks, Steve.
Thanks.
All right, sir. Harry, and you're good to go. Looks good. Hey, great picture too. I like that. Hey, how are you doing, man?
Thanks, Ken, and thank you everybody for being here. This is Harry Boxer, the Technical Trader. Here's a look at the front page of my site. Just wanted to tell you that if you're interested in what I'm saying today, feel free to come into the site for free for 15 days and benefit from everything that I do. You got a complete view of the entire site and all of our services for 15 days. Just sign up for free. No credit card needed. It's a pretty cool place. We have a trading room that consists with hundreds of people online at all times, posting on trades and opinions and information, and you can see that it's nonstop all day. And during the course of the day, I'm on with you guys before the market for an hour, during the market every hour for an update where I update your charts and go over what the current support, resistance, and targets are for my day trades that I do post. And in the mornings when I come on after we go through the focus list, so to speak, we have I take a couple hours in the morning before the market opens to go over all of the news events, all the stocks that are gapping, and taking a look at stocks that are moving in big percentages and or with big volume changes. And that's key for me, a price volume surge, a phrase that I coined many years ago. A combination price and volume at the same time surging is usually an indicator of strong money flow, and I want to be involved with that, particularly on day trades. Now, we trade 1 and 5 minute charts. And
Harry, let me quickly introduce you, say something nice about you right before we get that set up. Hey folks, Harry Boxer is the #1 stock picker I have seen in the world. He's the only other guy out there who picks charts like I like to pick, with big ranges that have huge profit potential. Harry Boxer's best-selling book, A Profitable Guide to Day and Swing Trading, is a must-read. It's the only book I recommend out there for active day and swing traders I've seen published in the last 20 years. Harry Boxer is brilliant. You have my word on it. He's the best out there. He picks the best charts I've seen, and he knows how to trade them, and he's a genius. So highly recommend Harry Boxer at thetechtrader.com. You have my personal word. All the people that I have presenting today are world-class people, and Harry Boxer is top of the class when it comes to being the world's top stock picker. He picks dynamite charts that actually work out really well. So I highly recommend Harry. I'm enthusiastic about the guy because he knows his stuff. So take it away, Harry. Thanks.
well, thank you, Ken, for those kind words. And I think the same of you, of course. I could tell you that I've been doing this for over 50 years, folks, and
wow.
That's a long time. And since I'm a kid, basically, and I can tell you right now that it took me 20 years to get it right. I'm not kidding. You have to do a lot of trading and a lot of experimenting. If you read Jack Schwager's book, Market Wizards, you'll see the vast majority of those traders spent years losing money before they actually got it and started to make millions. So be patient with yourself. Don't blow out of the market just because you had a big loser. And by the way, if you're in my room, you will never have a big loser. And the reason I say that is because I always give you targets and stops on every trade, whether it be a day trade or a swing trade. And we do give both. You can subscribe to my day trade service only. You can subscribe to my swing trade service only. I even have a service just for the weekend. It's called the Weekend Webinar, where I go over a couple hundred stocks and all the indices and technical indicators and the NASDAQ 100 generals, where I give you a complete review of the week and what to expect in the week going forward. For a lot of you who can't be day trading because you're working and you just don't have the time or the energy to be looking at 1 minute charts intraday, which is quite anxiety for creating. If you're not disciplined enough, of course, then you can simply subscribe to either the swing trade service or the day trade service. Anyway, today I'm going to show you stocks on a 1 minute chart that we've used in the last, just in the last couple of days for swing trade, day trade ideas. And I'm going to show you the patterns that I use and the setups that I look for. Every day I come in, I'm looking for stocks that are thrusting pre-market. Here's an example. Solid Biosciences literally exploded and then had a nice falling wedge. Falling wedges to me are one of the most fruitful and chart patterns. If you see a falling wedge breakout, you often would get a substantial move out of it. Here's a perfect example. When it broke out above the moving averages, these are all 1 minute charts, and it had a falling wedge. There's your breakout. It then popped and had a mini falling wedge right there. It then ran up and formed a larger wedge. Now we bought it on the breakout. I put a buyout under 4. I had a target of about 4.5 for a quick scalp trade. It reached 474. And then pulled back, formed the wedge and broke out again. We put another day trade out. That's twice. That one was at about 465. Then minutes, it reached 560, almost $1, and then pulled back and yep, another falling wedge. Broke out again. We put yet another trade on. This was 3 trades in 1 day. It exploded, and another falling wedge popped again, and then went sideways for the rest of the day. But even this setup, looking like an ascending bull coil or a narrowing coil there, would be a setup for Monday, wouldn't it? Potentially. But if it gets over 560, my targets are 635 and 7, and I wouldn't be surprised to see that based on the way this is moving. But there's a perfect example of one of the day trades that we put on. I have a swing trade on this stock called Perion. Let me show you why. When it broke out there, I put a swing on it. When it broke out there and it had a gap, I added to it. And you can see how quickly the stock exploded, literally. But once you break out across a multi-month consolidation with a breakaway gap on that kind of volume, I'm in. Stock went from about 7 3/4 to 1386 in 5 days, almost a double. And we're still long, by the way. I told a lot of us to sell half your positions when I hit 13.5, 14 zone, which you got right to 1386 on Friday. But more importantly, just as importantly, I also put a day trade on this one. Take a look at the 2 minute chart going back 5 sessions. Breakaway gap coil. When it broke out there, it was a day trade. Broke out there, it was a day trade. Broke out there, it was a day trade. And even there, it popped out quickly and came down. But for me, I'm still looking at a 5-day channel that says if this isn't done, your next target is around 15.5. Your stop right there, 11 3/4, 1185. This isn't rocket science, folks. If you look at the patterns and you recognize the patterns, which is my specialty, I've been a pattern recognition guy all my life. I have a photographic memory. I can see things forming before I even draw the lines. But every day I'm drawing these lines and I'm drawing these patterns in so everyone can not only see what I'm doing, but learn from it. Some of the traders in my room have told me that 2 months in my room is like 2 years in a classroom. So hopefully you'll glean something from it. And even now, if you look at Perion, this coil that's forming, I'm going to draw a line across what I see as support that was broken, now becoming resistance. Should this get above 1260.65 on Monday, I'm back in for a trade with a stop there. Another example of a day trade from Friday. Translate Bio, exploded pre-market and pull back. Right about when the market opened, the stock went ballistic and then formed an ascending bull coil. Right there we went in. I said this could be a quick day trade. Went from 24.30 to 25.60, about $1.30 in minutes, and then had a beautiful falling wedge. Guess what? Another day trade right there at 24.45. It popped to 25.20 for about 80 cents, and then went into a coil and then broke out. Didn't really get through the high though, but look at the setup for Monday. This would be a large ascending bull coil. Why is it ascending? Because the bottoms are ascending. That's always called, and if you have a flat top and ascending bottoms, that's called an ascending bull coil. It's near the apex. And by the way, this is after hours trading. I always include pre and after my hours, especially when you're trading 1 minute charts. But to me, if you take a measured move from 21 to roughly 25.5, you got 4.5 points. Add that onto the pullback low, and you got 28.5 as a measured move, potentially up in that zone. So I'll be watching this one Monday for a breakout above 25.75 with volume. If it thrusts from the get-go, these are going to be my targets up there. And so you can see the patterns that we look at: coils, pennants, flags. You know, these are continuation patterns. And if you read Technical Analysis of Stock Trends by Edwards and McGee, the Bible of technical analysis, if you've never heard of it, read it. And if you have read it, reread it. I've read it 11 times. You can never, glean too much from the same book over and over, because this book is it. It's all you need to know. Read that book, learn it, know it, and you'll be a much better technical analyst. Some more examples, and this is a home run. HJLI, I'm going to show you something, folks. Yesterday morning, the stock popped and formed a coil. Right there, I put a day trade on it. That was at 9.65, I believe, from what I remember. 9.65, right out. And this wasn't from the get-go either. This stock did nothing in the morning, nothing. And then boom, out of nowhere, pop right there. In 1 minute, it went up 68 cents right there, and then coiled. When it broke out of that coil, I knew this was going higher. It's exploded, wedged, exploded, had a bigger wedge, and then exploded again. In essence, from there, it's a 1, 2, 3, 4, 5 wave Elliott wave move. I had my people get out at that 17 level. I was a little surprised when it broke 16.5, quite frankly. I thought from this down there, it was going to fail, but instead it made a nominal high, sat there for 5-6 minutes, head faked everybody. But look how heavy the volume was. When you're in a stock that's already had 5 waves and the 5th wave comes on heavy, heavy volume, I always tell all my traders, either stop it or sell half and stop it and stop the rest. Those who didn't get out there were stopped out about 14.30. But you can see within a half hour it was $10. So you must, when you're trading a stock like this, you must trade with stops. GLSI was a home run, and it was incredible, because when it broke, I have to show you this. This goes back a few days. Let me do this. Hang on. Ken, this is the stock of the year, I think. Supposedly a breast cancer drug that, when no breast cancer has reoccurred within 5 years, everybody got excited. So the stock popped and coiled, and when it broke that coil right there, a bunch of us went in. There was a halt. Then it popped again. I said, the stock's going higher. There was a halt. Now this started here for us at 28.30 range. And within an hour and a half, it was 158, I kid you not. Notice that it never broke the trend line. But as soon as it did, I saw a reversal bar right there. I said, put stops in right now. Trading was halted again. Some of us didn't get out till the 90s, okay? But look what happened after that. Trading was halted for a long time, then opened and went down to 44. Of course, it did bounce back up to 128, and then you can see what it's been doing since. I'm not going to belabor the point that when you're in a stock that's running like that, keep raising your stops. Or, I mean, this was a home run for everybody in my room. Literally went from 28.30 into 158, and most of us made 30, 50 points on it. That's fantastic. But you can see that return to sender, 158, and on Friday it was back to 42. And quite frankly, I wouldn't be surprised to see the stock be back to 10 or 15 in the next month. But it's hard to say if that drug is legitimate or not. Yeah, of course, you don't always get stocks like that, but I just wanted to point that out, that that was a trade strictly based on the fact, way back here, before it did anything, all we knew was this, that it formed a wedge and it was popping out. You never know where a stock's going to go, right? Look at that explosive move right there and there and there. It just keeps going. Only one, and there wasn't one red bar after this level. And finally, when the red reversal bar showed up, that's where I told everybody to get out of stock. Okay, let's move on and show you some more. SNOA. Again, we're momentum players, folks. We're traders, we're day traders. If you want to participate in day trading, there's no better room than at techtrader.com. Pop coil pre-market. Then when the market, at 7 o'clock, it exploded. By 7:30, it formed a wedge. I told my people pre-market to buy this stock. It's going ballistic. From 12, it went up to 15 quickly and then fell apart. But right after the market opened again, here, it came down, popped and formed a little wedge and broke out. And we went long there at about 12 and a quarter. And within minutes, it was 15. And I told my people at the double tops and then triple tops and couldn't get through it, sell and stop underneath 13. Most of us got out at 12.85 to 13 range. The stock went down to 7. This is a typical of biotech stocks that pop and drop. You got to be in and you got to be out. You cannot let moths grow under your feet on these stocks. And I can't. And in my room, discipline is the key. Take a look at NH. Explodes, falling wedge, popped out right there. I put a day trade on it at about 4.25, I think it was. It went up to 6.25, 2 points in about 15 minutes. Then formed a wedge and broke out again. Some of us got trapped in there because it came down quickly, but I stopped everybody out in this zone here for a quick loss if you took that second trade. Yeah, I'm not 100%. Nobody is. Otherwise, I'd be on an island with Richard Branson somewhere. All right. Several more examples. Check out, same thing here. Exploded, pulled back in a falling wedge. That would be right there. It then popped out. We bought it there. It ran up and hesitated on low volume. Always look for volume and see what it looks like if it's pulling back a low volume. And then went vertical from 218 in about 10 minutes to 289. I had a target of 290. We were within a penny of that target. Several of us sold it there. Those that didn't were stopped out right there. And you can see that from 240, the stock went down to 165. You do not want to stay in stocks when they break. And in particular, the key for me when a stock breaks is what kind of volumes are breaking on. Take a look at this bar that went from 275 to 231 on 5.3 million shares. Look at that big volume bar. When you see that, just get out of town and don't ask questions. Why, when, and don't wait for a bounce. You can see what happened to it. Look at this beauty. Right at the close, the stock was trading at 265. And right after the close, some news came out and it popped from 272 to 320 and pulled back. This first pullback is where I said buy it with a stop under 287. That was right there. Notice how it popped and formed a wedge, then broke out of the wedge as volume really increased. And then it did a 1, 2, 3, 4, 5 wave Elliott wave, basic Elliott wave move. At which point I said top of the channel, 5th wave, exit. And I was at 390, it hit 393. You can see the pullback since then. But key is the price volume surge, the first pullback, notice how volume quickly receded right there. And then popped and pulled back again as volume really receded with a low volume ebb right there. At this point, the safest thing to have done was put your stop right there under those 4 bars. And that's exactly, well, you see it never was violated, then exploded. So, you know, my day trade techniques are always to watch for a price volume surge, watch for the first pullback. If the first pullback is a low volume consolidation per se, you can add a small portion of your position. For example, you want to buy 5,000, you buy 2. It pops out, breaks out, you buy another, you know, 1 or 2 more. It pulls back and holds support, breaks out, add to it. Folks, the key to trading is not averaging down. Never average down. If a stock's going down, exit. You'll find that every time you average down, probably that was a good place to sell it, not buy it. Every time you average up, it's a good place to buy it, not sell it. Most people, the biggest question I get in my room is, I sold it too early. How do I stay in the stock? How do you stay in the stock? Is you sell, just like you scale in, you scale out. Sell a quarter to a third of your position at every target, and then raise your stops. And keep raising your stops until you either stopped out or your target's met. In this case, you would not have been stopped out. This was not violated, that was not violated, this finally was violated right there, but we were already out. Here's a good example of a stock that in the middle of the day, it was going nowhere, it broke out. And it had a beautiful little pennant or mini coil, broke out right there at about 45. It was 48 and a half within 35, 40 minutes. And it was right at my target of 48 and a half. And people always ask me, well, how do you get your targets? By looking at previous highs, I look where resistance might be based on measured moves, Fibonacci, things of that nature. Combination of factors that I've learned over the years. But the beauty of my room is you don't need to do anything except come in, listen to where I give you stops and targets, and exercise execute. You have to execute and be disciplined. Number one thing is discipline in trading. If you're not disciplined, you're going to get that one trade that's going to smash your portfolio to smithereens. You cannot afford a big loss, ever. Live to trade another day by protecting your positions at all times with stops. All times, there's no excuses. Not mental stops. Because if you have a mental choice about stopping, you'll reconsider. If you reconsider, you can make a mistake. Also, don't fall in love with stocks. There's no reason to be buying a stock because you love the company. I'm telling you right now, if you love a company, you will lose money because you will not make a trade and you won't sell it when the charts are telling you to trade it. I'm a technical analyst for over 50 years, and I'm telling you that what works is the charts and the volume and the price action. It's all about that. It's not about what the company's news is. So, you always wonder, why does the stock go down when the news is so good? Because it's sell the news. Stock's been going up in anticipation of that. We all know that. Right? Some more great examples. INSG. Take a look at this stock. Started out with a pre-market coil. When the market opened, it exploded. We put a buy on it. Went from 13 to 15, 2 points in minutes. And came down in what I consider a falling wedge right there. Broke out. Stair-stepped up to resistance and backed off. This is where it became a buy. I checked what happened when it broke out. As soon as it broke out, it pulled back and formed a wedge. How perfect is that little baby? Always look at the apex where it's coming to the apex of a wedge, and look at the volume. When it's very, very low, anticipate a breakout. When it breaks out, right there, put a trade on. 13.95 to 14.73 in 15 minutes. That's the way you trade. Great example is Chewy. On Friday alone, at the opening, it exploded. Now, some of us saw this little baby. I consider this a sharply rising, ascending wedge. See it? That was a breakout. That was probably a buy right there. If you were able to scalp it quickly from like 80 3/4, you could in minutes gotten 83 range. Then it pulled back on a beautiful falling wedge again. These falling wedges work, folks. Watch for them. Right to the 50-day moving average, 50 period, excuse me, where that red line is. Pop, pull back, formed an ascending bull wedge. There's your breakout. I put a trade on it right there at 82 1/4. It quickly shot to 84, and then in the next several hours, if you were patient, you could have got 85 1/2. CNK started out the day with an ascending wedge. When it broke out there, it was a buy, 15.25. Within minutes, 16.44 for $1.20. Then another wedge formed and another breakout, and you could have bought it right there as it broke out at 16.20. And within minutes, 16.87. So these are examples of scalp trades. Veru. Look at this. Let's go back a bit. This is 2 days now. Popped and pulled back, formed the wedge, broke out, held the trend line. Now this is the important one right here. Right there. Broke out of that wedge and went vertical from 5 1/2 It literally reached 786, $2.35. I don't think it took 10 minutes. Then it broke out here from the wedge, and then it's coiling into the close. Maybe it's set up for Monday. Here's a good one. In the morning, it went back and forth. When it broke out there, I put a day trade on it. It ran up quickly and pulled back and formed a beautiful tight coil at the apex. You notice always when you see an apex, a coil or a wedge, when near the apex, when the bars are very little and the volume is very low, that's called a low volume ebb. Just like in ebb tide, when it's the ocean, when the waves, the tide goes out, it stalls for a second and then it comes back in. Well, this is the stall right there where I call it a Mexican standoff between buyers and sellers, and who's going to blink first? Well, the buyers blink first. Boom, 565 to 725. A nice quick 60-cent scalp. Then it collapsed, but we had to stop right there underneath the last pullback low at 650. Everyone was out at 650, avoiding a loss all the way down to 4.25. This is why you have stops. You never know how far they're going to go or when they're going to collapse. But notice again, if you learn anything from today, when it stock's in a trend and suddenly a big bar shows up, here's a 70-cent down bar on 800,000 shares, one of the biggest red bars of the day. That broke the trend and broke the back of the whole rally. So the two keys are looking for early pops and wedges and coils, and then breakouts. And then when your trend is reversing, looking for a big bar that ends the trend, and I mean dramatically so, with some big volume on the downside. You've got to be quick when you're day trading, folks, and you got to listen to my stops and targets. BCRX. There's an explosive move and a quick pullback. And when that pullback started to rally back up, that's when I gave this one out at about 780. It then popped and had a beautiful little pennant. Look at the low volume ebb right down there near the apex. From 785, within a half hour, it was 845. And this is the kind of trade we got in at 780 range, and we did about 65-cent trade. Not getting you rich, but you're making money. That's important. One of my favorite stocks currently that I think is going to be a home run this year. This is the Amazon of Africa. It's called Jumia. I want to show you the daily chart first of all. We were long Jumia on the breakout there. Most of us sold it on that reversal day. When it broke out again, we were long. When it broke out here, I doubled my position. And then when it got to the channel top, we sold a bunch. Why? It was up 11 days in a row. I said it's too far, too fast. It came down and had a big reversal bar and stalled. I went long here when it started to move. And the stock, I think, is at a double top and ready to explode into the 50s, 60s, 70s. I'm not kidding. This is a home run stock type of stock. I just love the look of Jumia. NNOX is another. We made a lot of money coming out of this wedge in here when the breakaway gap occurred, and there again. Notice this little flag? When it popped out there, I put a swing on it. Worked perfectly. Ran up to the target. I had a target at 60, I think it was 64.5, and we actually got to 69 and then reversed. Right now, with this reversal bar Thursday and then the pullback on Friday, I'm thinking if this early next week gets over 50, 50 and a half, it's a rock star, and it's going to go much higher. We'll see. I may be wrong. And my other favorite is NEO. I called NEO, folks. I know you're not going to believe this one, but at 4 when it broke out there, and 5 when it broke out there, and 14 when it broke out there. 3 times I put swing trades on the stock. 3 times it was a home run for everybody. Right now, it looks like a wedge, but I can't tell if it's the top. But we're going to be stopping NEO underneath 38, 8.5 range, because that breaks your trend line, lateral price support, and the 50-day moving average. You don't want to be long NEO if that occurs. Do I think it can go up to 70, 75? I do. Depends on the market, of course. Rising tide is going to float all boats. And conversely, the market comes down, and especially the NASDAQ leaders, and you're starting to see the deterioration or lack of leadership from your Apples and Amazons and Netflixes, and even only Tesla is the one that continues to make higher highs. But for me, the vast majority of market leaders have topped or are at least going sideways and not participating, and could be an indicator that if they start to break first, the whole market's going to break. Am I bearish now? I'm extremely cautious right now. Don't forget, it's a 12-year bull market. we are due for a big hit at some point, and all the fundamental conditions are in place. But whether the market cooperates with the fundamentals, we'll see. A couple more ideas and we'll be done. Well, Ken, it looks like we're running out of time. If they want to take or give me some questions, I'd be glad to answer a couple questions.
No, we're pretty wrapped up, but that was one of the most brilliant presentations. I called Neo at 16, so you got me beat, man. Harry's the best out there. Let me ask you one quick question. I was trying to rack my brains to think a smart question to ask you. And you're the only person who runs a chat room that I recommend other than mine, of everyone in the world. You're the only one. So, because you're the best. My question is this. Talk a little, just briefly about the importance of trading ranges, because to me, you pick these rock star ranges, as do I. But a lot of people, a lot of traders, they'll ask me about choppy charts that don't have sufficient ranges to make the risk reward work out. You pick charts that have big ranges. What's your thought on the importance and the value of ranges? Because to me, it's everything. Is the range is the story? That's what you trade, right? So.
Okay, well, to me, the best part about a range, it usually means a consolidation or a base. So what I want to see the break out of that range, because that's where, and if volume comes in at the same time, for example, I'm not calling this a range, but let's just say it was in a morning range in that area. And then it popped out. Right there was a trade.
Right.
And anytime I see, here's a trading range, and right there it popped, that was a breakaway gap. That wasn't a good example. But from the charts, and I showed you about, I think it was about 18 to 20 charts, 16 charts, whatever it was. Bottom line is, every one of these charts had the right setup. They all popped, consolidated, formed flags, pennants, falling wedges, whatever, coils, and then had the breakaway pop with volume. And look at this case here. Last example, INSG, popped. Big volume on the pop. And then it pulled back. And what you want to see is on that first pullback, is the volume receded? Indeed it has. So there's a lack of downside sellers. And as soon as it popped again, it went ballistic.
Great.
That's
stuff, yeah.
Yeah, that's what we see at detectrader.com. I invite everybody to come in free for 2 weeks. Just sign up, no credit card. And most people tell me they make a year or two's subscription costs in the first 2 free weeks. So it's a great place to be. And you'll find some very astute, brilliant traders, some of which have been there 10, 15 years trading with me.
Yeah, Harry's the guy to go to. So thanks. We got to run, but thanks, Harry. Yeah, brilliant presentation. You have my A+++ stamp of approval. You're the best out there. Be sure to get Harry's book, Profitable Guide to Day and Swing Trading too. One of my traders was asking about that on Friday even too. So thanks, Harry Boxer, and I appreciate you for being here, man.
Okay, see you later. Bye-bye.
See you later. Bye-bye. All right, next up, we've got Dr. Barry Burns, and it's always a pleasure to work with Barry, longtime friend and colleague. He's got a very logical way of approaching the markets, and I look forward to seeing what Barry's got to share with us coming up here momentarily. And Barry, take it away.
All right. Hello, Ken.
Hey, Barry, how you doing, man? Good to hear from you.
Thank you. Great to hear from you as well, as always. So should be able to see my slide now. If you could just confirm that real quick, and that, well, obviously great. You can hear me. Okay, excellent. All right, let me also bring up the chat here so that as people are, well, actually, I don't see the chat. That's okay. So welcome, everybody. I know we've had speakers before me and more coming after, so and sometimes people come in and out of these multi-speaker presentations. So for those of you who have been with all the presenters, well, good for you. That's the way to do it. But still, some people have come in new, so I've got to still put up this important disclaimer slide. And I'm not going to read through this whole thing, but yeah, it's very, very important that everybody sees this. And I know that sometimes people dismiss it. I know I've been guilty of that in the past because I thought, oh, that's just a bunch of legalese. Well, it isn't. So while you're reading through this, I just want to encourage you that you look at this, whether it's on my website or anybody's website out there, Ken's, whoever, we've all got to put them up there because the regulators have actually done you a favor by requiring that we do post this. What I mean is they're doing you a favor is because this is really where your education should begin. This is all the hype stripped away from trading. And, you know, unfortunately, there's a lot of hype in trading marketing. And so the regulators have said, you know what, you got to, everybody's got to, put out there in print to the public the truth. And the regulators have studied the truth and they want to protect you. And so this is the defense part of your game. And read this stuff. It's very, very important. All right, so I just want you to look at it that way. And, first, like it's a doctor, Hippocratical oath, first do no harm. That's what I'm doing there for you. So there's my ugly mug. I'm Barry Burns, owner and founder of Top Dog Trading. As Ken said, I am the author of Trend Trading for Dummies, part of the Dummy series of books from Wiley & Sons. I've received numerous Reader's Choice Awards throughout the years from Stocks and Commodities magazine. I've helped other authors write their books, work with big brokerage companies out there, and it's actually expanded beyond this now. This is an old slide, so yes, we've got all the other kinds of associations now. I've got some free stuff out there for you today. One of them is my podcast. So check out my podcast, been very, very popular. And I'd love for you to engage in that as well. Absolutely free, of course, wherever better podcasts are hope. YouTube, we're on YouTube as well. A lot of YouTube videos, over 200 YouTube videos, absolutely free. Check out the Top Dog Trading YouTube channel, subscribe, and enjoy. Now,
Yeah,
today
I like Barry's videos too, by the way. Larry has a very, Barry has a very logical way of approaching the markets, and I am a big fan of his YouTube videos. I've watched them for years and highly recommend them as well. They're really well thought out, man. So props for that. Good job.
Oh, thank you, Ken. I appreciate that. Yeah, it's a very popular channel. I think we've got about 86,000 subscribers now and tons of views. And like I say, over 200 videos, all for free. So enjoy. But thank you for that recommendation.
They're
so
good,
Today we're going to talk about something that it's definitely not new, but I don't hear people talk about it as much anymore as they used to. So, and that is cycles. So what am I talking about when I talk about cycles? Well, a chart has two dimensions. So we've got the time axis on the bottom and we got the price axis along the right side. And that's it. That's what we got when working with charts. And yet most traders only use the price axis. Everything's about price. Well, obviously that's critically important. I'm not dismissing that or even saying one's better than the other. But you got two dimensions to work with, time and price. And if you're not using time, then you're missing out on 50% of the information provided on the two-dimensional chart. So what happens? Well, how you experience this and how I used to experience it is people say, I get in and then I get stopped out. So I go along, I buy a stock, forex, futures, commodities, whatever it is, I enter a buy position, a bullish position, and then soon after that, I get stopped out. Almost like the market's looking at me and saying, oops, Barry got in, sound the alarms in all the exchanges, and Goldman Sachs, Merrill Lynch, Citibank, everybody's like, oh, wait, Barry Burns got into the market. We need to take him out. Not like that's going to be realistic or anything, but it happens so often that I started to wonder, it's like somebody got it out for me, maybe my broker, they could see my trades. So the common lament that I hear from students and that I used to have was I'd get in, I'd get stopped out, and then the real crazy thing would be if the market would continue in the direction of my original move, but not till I got stopped out. That was because I didn't know about cycles yet when I was doing that. One of my mentors actually at the Chicago Mercantile Exchange said, Barry, retailers are often right, but at the wrong time. And until he told me that, I didn't even understand I didn't understand him when he was saying it to me because I didn't understand this concept of timing your entries. W.D. Gann, of the two, time and price, he actually felt that time was more important than price. Now, I don't really believe that. I just believe they're both equally important, but for him, time was actually more important than price. So let's talk about this concept of cycles, of timing your market, timing your entries in the market. Now, there's several different types of cycles. We're not even going to cover all of them today, but just to give you a little feel for today, it's just an overview, bird's eye view. So you've got your calendar cycles, your seasonal cycles, all right? And that's just time of year. Probably one of the easiest ones to think of is the agricultural cycle. They sow in the spring and they reap in the fall, all right? So fine, you get the idea. And for people who trade soft commodities, that's a big deal. But in fact, that's how futures actually got started, was with agricultural fields, commodities, they would, the farmers took on a big risk where, hey, if they spent all the money, all the time growing their crops throughout the year, and then something happened, like a weather disaster, and their crops were wiped out, they were in trouble. They lost all their money. They couldn't make any money that year. So futures traders came along and said, hey, tell you what I'm going to do. I'll actually pay you in the future for that future crop. And I'll take the risk. I'll take the responsibility of some sort of crisis happening. And if that crisis does happen, you'll still get paid. Now, I need something, a little something, something to assume that risk. So I'm not going to pay you the full amount you would have gotten if you went to retail, but you'll be able to hedge against a major loss, kind of major insurance. So those are seasonal cycles. Volatility cycles, this is not directional, it's just the expansion and contraction of price swings. Coupling and uncoupling cycles, these are where various markets, industries, sectors will align themselves or disalign themselves from each other. Up-down cycles, now that's simply oscillations in the market, swings high, swing low, swing high, swing low. And then number 5 is order chaos cycles. Now we'll talk about this one a little more than the others because the others I think are more intuitive, but order chaos cycles. I rarely ever hear anybody talk about order chaos cycles. And brothers and sisters, I'm here to tell you it is critically important. So let's talk quickly about the first few. Seasonal or calendar cycles, agricultural markets, I mentioned that already. The retail sector, we're coming into that time of year. Well, we're in that time of year right now. With the holidays and more stuff is sold through retail. Travel, certain times people travel more than others, summer, spring, at least back in the olden days, pre-coronavirus. Now, here's the tricky thing about them, though. So it all seems very simple and easy, and it's like, okay, so I'll buy, retail stocks, let's say, for example, that are in the retail sector, and I'll buy them in November, and then I'll sell them, after Christmas or something. That's not the way it works in trading. So in trading, you probably heard the term buy the rumor, sell the news. So by the time that the retail stores come out and say, well, here's our numbers from this holiday season, it's too late. That's the news. Okay. So what traders do is we actually anticipate that way ahead of time, way before the retail numbers even come out. They're not always consistent. So just because we're coming into a holiday time, that doesn't necessarily mean that people are going to spend a lot of money, because it's comparative, it's relative. People are going to compare those numbers against last year and the year before that and the year before that. And so you can't just trade the calendar, in other words. You still got to look at the chart. And the charts tell you what the market is doing, what other traders are doing. Are they buying? Are they selling? The supply, the demand imbalance. All right. So that's just one of the energies. I call them the energies in the money, and that's what I mean by it. Energy of money is money flow, and it comes down to supply demand imbalance. Now, volatility cycles, we heard a little bit about this just from our previous speaker, by the way. I call this the ex-con pattern in the market. Expansion contraction is what that stands for. Now, most people trade this backwards, unfortunately. So here's the counterintuitive thing about this. If you scan for high volatility markets to trade, sometimes that'll work out, but other times you'll get trapped. Because there is a volatility cycle, in other words, the markets, think of Bollinger Bands would be one tool. If you look at Bollinger Bands, they expand, they contract, they expand, they contract, they expand, they contract. Well, if you scan for a high volatility market, which a lot of people like to do, thinking that, oh, I'm going to get a market that's really moving, really hauling, well, we got to watch our language here, really hauling patootie. Okay, because I want to get into a stock that's moving fast. I want to make money fast. Here's the problem. If you wait for the time that all the data has been crunched and it now will come up in a scan as a high volatility market, you could be coming into the end of that cycle of high volatility and be buying right before the volatility crushes. And the exact opposite of what you want to have is going to happen. So what I like to do is actually scan for low volatility markets And obviously there's other considerations in there where you look for then it to break out so we get early into a new high volatility cycle, not late. So again, you can use your triangles, your wedges, your Bollinger Band squeezes, your tools of choice. They're all good. And here's the basic idea of volatility, just wide range. By the way, this is a typical meta pattern of a day in the market if you're an intraday trader. So typically, let me find my little spotlight here. There we go. So generally in the morning, you get higher volatility, range from high to low. And during the lunchtime, it's more narrow range. And then the afternoon range picks up again. That's just a general meta pattern. Doesn't happen every day like that, but that's the concept. And if you want another way to see this, is just to draw geometric shapes. And if you've got a tall rectangle, that's high volatility. If you've got a long and narrow rectangle, that's low volatility. All right, again, just basic concepts here, just so that we're all on the same page. All right, next we've got coupling and uncoupling cycles. These can be traded very well. I use this very much in my swing trading especially. So what we do is we establish a benchmark, a reference point to which we're going to measure other markets. So typically the S&P 500 is what a lot of people use. You can use others as well. And then we look at sectors, industries, countries, right? ETFs of other countries, currencies, commodities, interest rates. They will couple or uncouple with your benchmark and equity index from time to time. In other words, when I say coupling, they're moving with it. Uncoupling, they're moving against it. And this can provide some really, really powerful signals in individual, as I said, sectors, industries, etc. These are really powerful. Now, again, you want to get in early to the uncoupling. So one of the ways, actually I do this two ways. So one, if they're when they're uncoupling, I get in early into it, or if they've been uncoupled, then I look for them to start aligning and trading in concert with each other very early. So what I do for this is the tool that I use as a relative strength tool, and it's not the RSI. Again, don't have time to go through the details of this. That'd be a whole almost course in and of itself. But what I do actually is I change the chart from a regular chart to a relative strength chart. So you'll go back a certain time, say 90 days, where it starts at 0%. So percent change chart. I believe TradeStation calls it a percent change chart. And so we're looking at that, which ones are, you start at a certain point of time where all your indexes have changed to 0%, okay, because they all start on the same day. And then you look at that percentage change, you draw trend lines, and you look for coupling and uncoupling. Now, up-down cycles, these are the ones that most people are familiar with: swing highs, swing lows, swing highs, swing lows. And one of the ways to really look at this is to combine all of these with order chaos cycles. So you want to understand that you get swing highs, swing lows, swing highs, swing lows, even in chaotic markets, and they don't do you any good. So you've got to do all of this, and that includes volatility cycles. That's got to do with your swing high, swing lows, as I said. You've got your calendar cycles. All of these must be subjugated, if you will, to the biggest and most important cycle of all, and that is order chaos cycles. So just as a quick little reference here, again, make sure we're all on the same track, because I know I'm going through this fast, but this is your up-down cycle: up, cycle high, well, cycle low, cycle high, cycle low, cycle high, up, down. And by the way, one of the key things on this is, if you're in an uptrend, you want to make sure that the range is going up, and this is your time going up. Okay, and the down move, that's your impulse move in an uptrend. And the down move, we want it to spend less time going down and less price range going down. So again, here's where people only look at the price range on the retrace. No, you should also look at the time range on the retrace. Okay, so now that we've got that, as I said, we've got to use all these cycles within, Yeah, I do have a cycle indicator. Again, we don't have time to go through all of this, so I will show you this. I'll just give it to you at the end. I'll give you a link where you can get my cycle indicator, all right? So what I want to focus on right now for the last 10 minutes here is the order chaos cycle. So there's a certain school of thought out there, and you might have heard of the book Random Walk Down Wall Street, where they basically say the markets are perfectly efficient. Everything that can be known about the market that you would use to make a decision is already known, and therefore trading is basically a fool's errand because, well, there's nothing, no information you can use to help establish a probability into the future. And so that's the random walk theory. Total chaos. And if that's true, then we can't trade and make money. There's another school of thought that's another extreme, and these are people who say the market's perfectly orderly and predictable. Usually these people are using market geometry to predict the market 5, 10, 20 years into the future. Okay, and that's where you get into your WD Gann type of mathematical predictions. Now, both views continue in the world today. We still have followers of both of these views. And part of the reason is, and as I've studied each one in depth, I read, the classics in each of these views, and I thought, well, this one makes sense. And then I read the other and I thought, well, that one makes sense too. How can they both make sense? And then I realized, oh, they both have merit, but at different times. Now, as soon as I say the word time, you should be saying cycle. And this is why overtrading is the cardinal sin, because people are trading inside of chaos. And so they might have a viable trading methodology, but you can only trade that within an orderly time or period of time of the market. If the market is simply moving in chaotic methods and you trade your proven trading system, you will lose money. You will lose money. And then you wonder, why is this working sometimes? And why isn't it working at other times? Well, it's because you don't have a way of determining when the market is just moving in a chaotic period. So how do I do this? Well, basically what I do is I have 5 energies. I mentioned the word energies before, energies of money flow, and each one is uncorrelated. So my 5 energies are trend, direction of the market, momentum, the strength of that trend. Number 3 is cycles. Now here I'm referring to cycles highs, cycle lows, swing highs, swing lows. Number 4, support resistance. These are levels that are potential blockages of buying and selling. And the 5th is the fractal energy. That means multiple time frames. So I measure the energy in the chart. Measuring the energies is very rule-based. It's very objective. And therefore we use indicators. Now, I know a lot of people don't like indicators, and that's fine if you don't, but indicators don't make us money. I do agree with that 100%. So I'm not saying that, but what indicators do is they are mathematical equations. Literally, they're math functions. And math, last time I looked, math is pretty right most of the time. So you could say, in a sense, that indicators are never wrong because they are just evaluations, they're values, objective values, numbers that are created when you take data, namely price, time, volume, whatever energies of money flow, the data that goes through the market, and it puts it through that math function. And that number that it cranks out is not wrong. It's just accurate to what that indicator was designed to do. Now, you have to understand and learn, what does that mean in terms of the market then? And sometimes it might mean that, well, the market is just chaotic and random, and it can tell you that. So determining probability scenarios. How many energies are these aligned? So we got 5 energies. The key is, by the way, to these 5 energies of money flow: trend 1, momentum 2, cycles 3, support resistance 4, higher time frame 5. The key is that each one of these is uncorrelated to the other 4. So they are 5 independent ways of measuring money flow mathematically. And no one indicator will make you money directly. But when you put all 5 together and all 5 say bullish or all 5 say bearish, now, do you still know the future? No. Do you have certainty? No. Do you have probability? Yes. And that's the best we can do. So I score a trade 1 out of 5, depending on how many of those energies are all aligned, bullish or bearish. It's like taking a trade to court. You need 5 independent witnesses, and that's the key. Can't put 5 trend indicators on your chart and do this to establish a preponderance of the evidence. So here's what it looks like on my charts. I'll just give you a little visual here now that we've talked about the concepts. So 5 energies aligning at the same time. So here's our trade right there. So I use the 50-period simple moving average as my trend indicator. Price has gone from below it to above it, retrace. That's a first retrace in a new trend. Is that enough to trade with? Nope, not at all, not even close. But it's one piece of evidence. We're building a case here. Number 2, is that a strong trend or a weak trend? Well, here's my momentum indicator down here. It's gone from below 0 to above 0. What we're looking for in a trend retrace trade is, does momentum come out a little bit but still hold above 0? We don't want the strength of the market to go to 0, but if it stays above 0, then we say, okay, we're early in a new trend and it's a strong bullish trend. Then when to get in? All right, this is where I want to get in at the right time and not get in, get stopped out, and then the market goes up. So number 3, this is my cycle indicator. This tells me swing highs, swing lows, goes from green to, or red to green, boom, okay. So that's the right time. So far we got 3 out of 5. Is that enough? Nope. Still wouldn't put my money at risk here. Money's too precious. I got 2 kids in college. I'm not gonna throw my money at the market. Market doesn't like me, by the way. Market doesn't like you either. You know why? If you ever felt like the market is against you, it literally is. And the reason it literally is against you is because everybody with the market is made up of market participants, and they are trying to take money from your account, put it in theirs. So in that sense, it literally is. Support is number 4, and we got the red line there is 50% Fibonacci retracement. And number 5, look at our next higher time frame, and look, momentum is screaming to the upside. So 1, 2, 3, 4, 5, put it all together, and that's a 5 out of 5 trade, and I'll take that every day, all day. All right, oops, I just got a couple more slides here. We're just about done, but I can't get it to click. There we go. So everything works sometimes. Nothing works all the time. With money on the line, what you want to know, when you face a trade, will it work this time? So I wait for the alignment of the 5 uncorrelated energies of money flow to put the odds on your side. And there's my whole methodology in one sentence. If you want to write that down, be my guest. My methodology is not challenging. It's not difficult. It's very, very simple. The best things in life usually are simple. And that's it. Trend that is strong at the right time with support at your back and confirmed by the higher scale. That's it. It's very robust and adaptable. Works for all markets, all time frames, stocks, commodities, options, currencies, futures, day trading, swing trading. Why? Because we are simply trading money flow and all markets based on auction theory, supply, demand, how much is someone willing to pay for something. So what I have for you today, just to finish up here is, well, I got nothing for sale, but I will give you some free stuff. So I'll give you one of my free mini courses, and this is not just a general course. This is a very, very specific course designed that when you come out the other end of it, you can start making some money trading. And then if you want to buy some of my other courses, great. Use the money you make from trading to buy my other courses. If you don't, that's cool too. Whatever, it's your life, and I'm just here to help you as best as I can. So you're going to get this course, which is called How Professionals Trade Differently Than Amateurs. It's 5 little videos, interactive quizzes at the end. And in this, like I said, I want you to start making some money with this course for free. I give you a very specific but very simple, probably my simplest trade setup called the rubber band trade. And I show you the setup, how to trade it, all that stuff. And again, I encourage you to start paper trading or simulate trading, demo trading before you put real money in. But it works like a charm. I still personally take this trade every day. And the best way for me to prove myself is, well, actions speak louder than words. If I can get you making money, then that's the proof. Oh, and as I mentioned, my personal cycle indicator, you'll get access to that as well. That's in a little recorded webinar now, and it's just a modification of an indicator that's already on your chart. So you can use this on any charting platform. Just go to topdogtrading.com/free, and you can get it there. So yeah, that's what I got for you. And I finished 2 minutes early. So Ken, I'll turn it over to you. If there's any questions or whatever, if we need to move on to the next speaker, you let me know.
Well, excellent presentation. And thanks so much, Dr. Barry Burns. You're a splendid example of what the founder of the quality movement, W. Edwards Deming, called correct thinking. That's one thing I get from you, Barry, is everything you say makes sense, and it's a matter of adapting your strategies. Like today's takeaway, I liked your high versus low volatility and drawing the squares around that. That's really important to understand if you're in a high vol versus low vol entry setup. Another thing, when we did a webinar a little while ago, something I picked up from you is how to filter blocks on tape reading, which as an expert tape reader, that's the best tip I've ever learned in my life from anybody, and that was from you, from filtering blocks on the tape. So you're one of the good guys, and thanks for being here so much. And traders highly recommend Dr. Barry Burns. He's one of the good guys. He actually knows what he's talking about, and one of the educators you can trust, and his stuff makes sense. So thanks, Barry, for being here. Appreciate it.
Thank you, Ken.
All right, well, thanks so much. And next up, almost last but not least, how are we doing so far, folks? Give us a rating 1 to 10. 10 means you love it. 1 means not so much. For the overall event so far, we got Larry McMillan, who literally wrote the book on options, coming up next, and then I'll be wrapping up today. Nice, short, and sweet. Do you guys like the 30-minute format? I do, because it's a great way to get tips from people without dragging things out and getting their best and brightest as we move on. Now, Larry, I'm going to turn this over to you.
All right.
And you, sir, have the floor. Next up, we've got Larry McMillan, literally wrote the book on options trading. Absolute genius. I've learned a lot from Larry on the VIX, because I trade the VIX ETNs all the time. I don't know if the VIX is overdone. It feels like it. But anyway, thanks for being here, Larry McMillan, and take it away.
Okay. You see that all right, Ken?
Yeah, looks great.
All right, good. All right, so we have a brief period of time. I'm going to discuss the current state of our indicators, and then I also want to talk about a couple of things that are very interesting in the option market right now. One of which is put-call ratios in depth, and then also the spec trading that's going on out there. Just a little background. I started this company as a derivatives research firm back in 1990 after it came off a prop trading career on Wall Street. And at first we were just doing derivatives, we were just doing research newsletters, but then we moved into money management after some successful recommendations and things in the 2008 crash. And then we also do a certain amount of option education, things like this, and mentoring. Our managed accounts are up nicely on the year, and I know a lot of people can say that now, but we were able to say that in March because of the volatility trading strategies that we had. And our newsletters are reflecting those same, profitable kind of trading. We are going to be offering a 30% discount on our best top 2 newsletters. I'll come back to that later. So we're going to take a look at these 4 things and then those others in addition that I mentioned. I have an important rule, though, actually 2 rules. One is that oversold does not mean buy. So in February, when the market started down, it was probably oversold 3 or 4 days into it, but it were another 3 weeks. So market can go down a lot more than you expect when it's oversold. We need to wait for confirmed buy signals is what my point is. And more apropos today, overbought does not mean sell. So we have a number of overbought indicators, but that's happened before, and the market's really probably in some sense been overbought several times since really the summer, and yet we haven't had a meaningful sell except for that one time in September. So here's a 2-year chart of the S&P. Obviously, there were a couple of extreme oversold conditions here, March of this year and that Christmas, December of 2018. And then we also have had some pretty overbought conditions, January of this year, September, and then right now. So as I said, we don't just buy because it's oversold. We wait for it to rebound. I'll show you some of the indicators later that we use. Currently, we're viewing this market as in a bullish stance unless it were to break through this support level right here at 35.50. As long as we're above that, I think the market can work its way higher. Obviously, there's a little resistance at the highs at 37.05 or whatever it was earlier this week. So we broke above, I call it Pfizer Monday, was November 9th. We spiked up that day and made a high, and then had trouble getting through it, but we finally did get through it this week. Technically, I guess you could say, I say there's no resistance at all-time highs, but we're a couple of days off the all-time highs. And there's a little bit of support right where we bottomed out yesterday. And then I think the more crucial support is what I mentioned there on the chart. So 35.50 is our change of trend sign, but we're bullish unless that breaks. So another thing we look at is we call them McMillan volatility bands. They're similar to Bollinger Bands drawn around the market. And TradingView.com is a free website. I don't know if you have ever looked at it or not, but it's a very nice free charting website. And if you're interested in these, you can overlay them on the chart. This is the S&P chart, and if you have the volatility band implemented on there, you get these little red and green arrows, depending whether you want to buy or sell, of course. But so there's a buy signal there, sell signal there. This one is a little premature. This one also a little premature, and then the sell signal in December. We had been using, if you're familiar with our work, something called modified Bollinger Bands, and they were just giving us too many premature sell signals, like here, for example. So we were, the sell signal didn't occur until there. So this way requires confirmation of the band, and it's a really good way to get a handle on a market that's really moving fast, especially say these days, some of these SPAC stocks. So right now we do not have a current signal from the volatility bands. Volatility has been fairly high still, and the bands are wide, so we haven't moved outside the bands in a while, since September. Put-call ratios is a very interesting part of the market. We use the equity-only put-call ratio to gauge our market opinion. That means all stock options that trade. And the theory of put-call ratios was designed by Marty Zweig back in the 1950s. And he realized that it was a contrary indicator. If there were too many people buying puts, the market went up. And if there were too many people buying calls, the market went down. So quantifying that, of course, is difficult, but it can be done. And we do it this way. So if a stock, let's say we have this stock and this put-call ratio charts are supposed to be inverse to each other. We post about 650 put-call ratio charts on our website every day. So let's say we're looking at this stock, and the stock is dropping. So as the stock is dropping, people are buying puts. Puts are in the numerator of the put-call ratio, so they're going up. The ratio is going up. But eventually, we come to a point where we form a local maximum on the put-call ratio chart. That is a buy signal for the stock. So then ideally the stock starts moving higher. As stock is moving higher, people are buying calls. That drives the ratio lower. Eventually the ratio comes down and forms a local minimum, and a local minimum is a sell signal for the stock. So we look for these local maximum, local minima, and also for this symmetry. So this is not a current chart, but on top is the S&P 500 index. And on the bottom is the equity-only put-call ratio. And you can see the inverse symmetry that exists most of the time. So that's why we use the equity-only put-call ratio to predict the stock market. So here's the current equity-only standard ratio, meaning just using the volume of the options. There's a couple of things that stand out on this chart. One is this peak in the put-call ratio. Remember, local maximum is a buy signal. That came on March 24th. Of this year. That was the highest in history for this 21-day moving average. Our history on this goes back to 1993, and obviously that was a good buy signal. There was a sell signal last January. It was a little bit premature. The market did go down a little bit, then rallied to new highs, which was a great fake out rally by the market. I heard Dr. Burns say the market is your enemy. That's a kind of a move your enemy would make, and then straight down after that. So you can see the sell signal remained in effect, though we did not actually form any local maximum there. And so again, a good signal. This was at the time the lowest the put-call ratio had been since 2004. So 16 years, and that these ratios tend to move higher over time because more institutions buy puts. So that was really amazing. But what's even more amazing is that since basically the summer, we've been lower than that. Currently, we're at the lowest we've been since 2000. 20-year low on this ratio. Now the tech boom of the late 1990s did have lower ratios, but it looks to me like we might be heading for those. In any case, the last signal we had was a buy signal here in mid-November, and that's still in effect. So the ratio is trending lower. As long as it's going lower, that means we're on a buy signal. Eventually, it'll come down here and bottom out, and we'll get a sell signal, but I don't really know where that is. So this indicator is bullish right now, even though it's extremely overbought, being at these 20-year lows. But again, as I said earlier, overbought does not mean sell. Now we can also calculate a weighted put-call ratio, which measures the dollars being spent on puts versus the dollars being spent on calls, not just the volume of each. And it comes similar, very similar timing on the signals, just a little bit more extreme. So again, you can see we had the nice a buy signal in, where's my pointer? We had a buy signal in March, and then after that, it moved all the way down and basically stayed in a downtrend until the one in September, which was the lowest since 2004. We wiggled back and forth a little bit, and now, again, we had a buy signal mid-September. We're still on the buy signal. We have not gotten quite down to the September lows, but pretty close. And you can see, again, a little bit premature but accurate sell signal last January. So these ratios are bullish because they're still declining. They've been excellent, well, for many years, but this year has been a good year for them in general. The sell signal in January, the buy signal in March, sell in September, and now we're back on the buy side again. So it's bullish. This indicator is bullish until these ratios begin to rise, even though they're very overbought. Now, I did want to point out something about these put-call ratios, though. They're getting to a state that we've really almost never seen before. The total put-call ratio, which is all stock options plus all index options, that's the lowest it's been in 20 years. The CBOE's equity-only put-call ratio, the charts I just showed you there include options traded on all U.S. option exchanges. I think there's 9 of them. The CBOE is just one, but it's the biggest one. And they publish their put-call ratio, and a lot of people follow it. I only have that data going back to 2001, but we're currently at the lowest in that time period. So these very low daily readings, and by low I mean less than 50. 50 means 50 calls traded for, 50 puts traded for every 100 calls. Below 50 means, it's more than twice as many calls trading in a day as puts. These very low daily readings used to be quite rare. Now they're becoming fairly commonplace because we have big speculators like SoftBank, small speculators like Robinhood. I don't know how to classify David Portnoy, but we got him too. And they're all buying calls, and they all seem to be making money. Here's how the daily equity-only put-call ratio readings are on the CBOE are normally distributed over time. So we have about 6,000 data points here, and of the total readings less than 40%, it's about 0.8%. So less than 1% of all readings in history have been less than 40. Between 40 and 45, it's almost 2%. Between 45 and 50, it's a little over 5%. You can see the majority of the readings are here between, let's say, 55 and 75. That's normally where the majority of the readings are. Now, the next chart I'm going to show you, the blue lines are the same. The red lines are this year, 2020. So this year, 5% of the readings have been less than 40. And by the way, this one that I showed you here, that includes this year. So that's not the previous years, that's all inclusive. This year, almost 15% have been between 40 and 45, and 23%, 22.5% have been between 45 and 50. You can see that we also had some very extreme readings because of the March sell-off. So we had a couple of times where the put-call ratio got crazy on the upside. What we haven't had is too many here in the middle where we normally have these high readings. This chart just says it, same thing a little bit differently, and that is on the average year you'd have 5% of the readings in any one category. It's been 20 years in this study, so 1/5, but this year 36% of the readings have of all time below 40 have occurred this year. 37% of the readings between 40 and 45 have occurred this year. Just crazy numbers. And of course, it's still a little bit on the high side over here from March. Where there hasn't been much is right in the middle where you normally have things. So we kind of summarize this, and I took by year. This table here shows by year how many times the put-call ratio has been was 45 or less. So in 2001, there were 18 days where it was 45 or less. 2003, 16. 2008, 0. All these years, 3, 0, 0, 3. All this, nothing. This year, 60. This is up to date through yesterday. 60. There's been 137 in history out of 6,000 trading days. 60 of the 137 have occurred this year. So let's look and see what happened on those other years where we had some high numbers. In 2001, we had 18 days, and then 2002 was a bear market. 2003, we had 16 trading days, and 2004 was a flat, dull market. 2010, we had 13 days, and 2011 was a bear market later in the year. So I have to say it doesn't look so good for 2021 based on this number. I mean, this is just crazy. And, you know, you might say it's different this time, but it's never different this time. It's never different this time. So
that's very valuable. That's very valuable information, everybody. Pay attention.
So when these ratios turn up, this market will go down. Just, you know, the market can stay overbought longer than you think, but this is a dangerous situation that we're sort of facing right now. By the way, though, remember, overbought doesn't mean sell. You need to wait for the actual signals to occur. Another thing we look at is market breadth. That simply advances minus declines on a daily basis. You can keep a cumulative total of that, and also you can keep an oscillator. We keep an oscillator. We actually keep two sets of these. One is using New York Stock Exchange data, very normal. Everybody sees that. The other is what I call stocks only data. It's the stocks on which options are traded. So there's always 6,000 of them now. We're listing these days about 3 or 4 a day, it seems like, with all the SPACs and everything. So this chart is the oscillator for stocks only data, and it goes back to 2013. And the oscillator is oversold by my definition if it gets below minus 400. So that's the green lines. You know, the market's really been going up most of the time since 2013, so we haven't been oversold too often, but we did get massively oversold here in December of 2018, right before Christmas, and then we matched that in this year. So again, oversold does not mean buy. We wait for the buy signal to occur. That's when it stops being oversold, and you miss a little, but we got in January 8th of 2019, so that was very early, and here I believe we got in around April 4th or something. So there's plenty of movement left afterwards. And this oscillator has been doing some pretty good signaling of late. We had a buy signal. Well, first of all, I had a sell signal early September, then a buy signal in October, so a buy in November 2nd, I believe, and we're still on that buy. So now we've moved up here into overbought territory. And that's fine. As long as the markets continue to go up, overbought is fine. But eventually, though, we'll fall back here, cross back below the red line, and that will give us a sell signal. But right now, this is still on a buy signal in modestly overbought territory, so that's good. We're still on this buy signal from November 2nd. Cumulative breadth, well, I said you can just accumulate the breadth every day and add the number up. That has recently been making new all-time highs as well. I think last Wednesday was the most recent time. And then we also look at cumulative volume breadth, where we take the volume on advancing issues minus the volume on declining issues every day and add that up. That's been making new all-time highs too. What we look for from these cumulative indicators is a negative divergence. They don't necessarily have a positive divergence. The market could drop right after this has happened, that they made new all-time highs. But if they start to deteriorate and the market's still going up, that would be a sell signal. We don't have that at this time, but we'll be watching for it. And then the last thing we look at is volatility. So VIX is the best volatility measure, or one of the best. And the trend of VIX is important. It should be trending opposite to the market. And also spike peaks on the VIX chart are important too as buy signals. So here's the current VIX chart going back about a year. You can see the trend changed right here. This is the 200-day. This is the 20-day. So right there, which happened to be February 20th, the 20-day crossed above the 200-day, and VIX itself also crossed above the 200-day. That's a sell signal for the broad market. It was well timed. The reverse finally happened in late July, where because the 20-day had gotten so high, VIX had gotten so high, it took that long for it to come back down and cross back below the 200-day, and VIX is below. So right now we're sitting right here. VIX is, I think, stayed kind of high. I mean, realized volatility is down to 13%. VIX is at 23. That's a pretty big difference, 10 points between realized and implied volatility. So it's a little bit of a danger. I mean, it's a little kind of just a caution sign. I wouldn't say it's all out sell signal, but the 200-day moving average is going to start to decline here, because numbers, this 200 days ago was just about right here. And so these numbers are going to start coming off, these big numbers, and smaller ones are coming on. So this will start to decline, and the 20-day will start to go up. And if they cross over like that, that would be the sell signal. But again, not imminent. So just sort of summarizes the state of the VIX chart. So to put it all together, we have this. So we saw the S&P chart is still bullish, still trending higher. And in my opinion, as long as it holds above that support at 35.50, it should be fine. So that's a bullish indicator. The pick-up ratios, we saw them, they're diving down to 20-year lows, but they're still diving. So as long as they're going lower, they're on buy signals. They're overbought, but they are still bullish. The breadth oscillators, we looked at the stocks only oscillator. They're on buy signals, and we're not seeing any negative divergence from cumulative breadth or cumulative volume breadth. So again, a bullish indicator in overbought territory. Now VIX, I classify that as somewhat bullish because VIX is still pretty high. That worries me a little, but not enough for me to worry too much about some of the other things. I had mentioned the spike peaks on the VIX chart. I'll just go back to the VIX chart for 1 second. It's right here. So these B's on here are the VIX spike peak buy signals. There are no sell signals from this system. It's a trading indicator that we put together. The red letters are successful signals, and the blue ones are not. So we had a successful signal, a buy signal at the end of March, and it's expired. This system only trades or holds a position for about a month. So this was bought at the end of October, so it ended its career or whatever there. So while that's useful to have, we have not had a VIX spike peak buy signal recently. So I'm returning to where I was. So VIX is somewhat bullish. We don't have that spike peak buy signal in place, but we do have VIX and the 20-day trending down below the 200-day. So again, somewhat bullish. Now, there's another indicator that I call the term structure, the construct of volatility derivatives. We look at the VIX futures and the VIX options, and right now they are also in a modestly bullish state. Again, being pretty high, the VIX futures are all trading out into next year, trading at like 25 or 26. 25 is really kind of the long-term average of VIX. If you actually go back and take the average, it's just in recent years we've been so low, so far below that we've kind of forgotten that, I think. But it's still a little bit it's not completely bullish. But if you look at this list here, I don't see the word sell anywhere. So we're still bullish. We're staying alert. We're trying to ride the trend. We roll long options up, long calls up when they're get deeply in the money and are profitable. And we're not going to start selling until we have confirmed sell signals. Now, those could happen quickly. Some of the things like new highs and new lows, that's very bullish as well right now. So we don't really see anything that's all that close to a sell signal. The shortest term indicator that we have is those breadth oscillators. So that might be the first thing that would turn. I want to finish up by just mentioning SPACs, because SPACs are the crazy thing in the market right now. And of course, when crazy things are in the market, they're in options too. A SPAC is a special purpose acquisition corporation, and it's a way of taking companies public that I think is actually more fair than IPOs that the investment bankers run. But a person or a company, usually a group of people, will form a SPAC, raise some money, selling shares in the SPAC at, say, $10 a share, and then they'll find a company to take public, like DraftKings was probably one of the more famous ones, and then they take the company public, and the SPAC merges into the stock, and then it's off and running. So there's usually an initial strong move when the company says, oh, we found somebody to take public, but then it fades. And so it comes back, and we're doing nothing at this point. But then if it later exceeds the peak from item 1 here, that's when we would buy. And if it has listed options, we generally take a look at those too to see, perhaps there's a better strategy. So this is DraftKings. You can see it was trading at 10 back here to start with. They announced the company, it was, I think, DEAC or something. And they announced they're going to take DraftKings public. There was an initial move. Back then, took 2 months. Now it takes 2 days. And then it backed off. Came all the way back to 10 almost, and then started up. So then we rose above here. That's the buy signal. And these are pretty volatile. So you need to use a tight stop. This is a parabolic sort of moving average here. And that we were stopped out here. Then it once again went to a new high. Again, buy here, stop out on the parabolic moving average there. But so that's one way to trade them, just straight up. But if we look at options, it can be much more interesting. So on top there is the volatilities. The yellow line is implied volatility, and the red line is the 20-day historic volatility. So you can see the yellow line's above the red line most of the time, which means these options are overpriced and therefore can be considered an option selling strategy, such as cover call writing or perhaps naked puts. And DraftKings was a good example of this, but now they're even crazier. This is LCA. So you can see here the stock was trading at 10 for a long time to begin with. And then they announced, and the spike, as I said, now the spike peak occurs in 2 days, and it backed off from there, went all the way back to 11. Came up and finally exceeded 11 right there. So that would be our signal to buy the stock. But I looked at the, on that day, here's your realized volatility, and here's your implied volatility. And that's a huge difference. I mean, 130, is a measure, it means something statistically, but I'm just saying, compare, it's 130 and this is 65. It's not supposed to be that big of a difference. So right away, I said, well, wait a minute, I don't want to just buy the stock. I need to be selling some options. So what I actually did there was bought 700 shares of stock and sold 5 calls. But you could also sell naked puts, and naked puts on these things are very, very expensive in general. It has since, of course, it backed off again and then came back through again. So it's really in its, I guess, if this is the first wave, then this was the second wave, and now the third wave. But the options are still getting even more expensive. So my suggestion in these things is they make great candidates for cover call writing, or naked put selling is really the same thing as cover call writing. Anyway, we're just about out of time, so let me just finish up. At this website, optionstrategist.com/trading summit, we're offering 30% off on our 2 best newsletters. One is Daily Volume Alerts, which has all the signals we talk about. Plus, we look at takeovers too, unusual volume for takeovers, and we're not like the guys on TV that have one every day. We have maybe a couple a month. That's really all that's ever meaningful. We also have the Daily Strategist newsletter, which is our premier newsletter, comes out twice a day and includes the weekly letter that's been published for 30 years, the Option Strategist. Again, same website. I also have a YouTube channel, and I invite you to be a subscriber. I record a market comment every Monday morning. And we have 2 new newsletters. One is just for put writing, naked put writing, high probability trading. And then this one is special situation alerts. It's off to a very hot start. It's being written by a friend of mine in London. And very contrary, but stocks that are going down we buy them sometimes, and stocks that are going up. It's a very, very unusual approach, but interesting. So I invite you to visit our website, go to that URL there, and we will be sending you a PDF of this webinar as well. That's my contact information. So Ken, I think I'm just about right on time.
Well, you're perfect, Larry, thanks.
Okay.
Hey, can I ask you a quick question?
Sure.
I'm vitally interested in your answer to this. Thanks for the 3550 support level in the S&P. On the VIX, we're at 2331, and I don't know who else believes that the market may be overbought, but at some point may be due for the mother of all sell-offs, and I'm looking for when to go short by buying into my inverses like VXX and UVXY and whatnot.
Right.
What's the sell signal, the bear signal on the VIX? Is it when it recovers the 200 SMA over 32 or so, or what would you be looking at to start to, if it does, the S&P will likely be getting close to that 3550 level, but what VIX level would indicate potential bearish reversal in the market if you have any insights? Because you're the total expert on the VIX, and it's vitally important to me because I trade the VIX ETNs all the time. What's the VIX level? Would it be that 200 SMA at 32 breaks above that indicates we may have some bearish sell pressure coming, or is there a different price point?
Well, the 200-day is going to be coming down. So for me, it would be the crossover of the 20-day over the 200-day. That would be a sell signal, assuming VIX is keeping pace with it. But also, the shorter-term one we use, if VIX rises 3 points over any 3-day period, that's also a bearish sign, and that won't last for that long. But that's usually a very short-term signal. Bearish.
Okay, that's good to know. Okay, thanks. That's valuable intel. I appreciate it, man, because I'm trying to put my daughter through an MBA program, and I want to do it with my trading wins by flipping into inverses in the market. So appreciate it. Hey, thanks, Larry McMillan, for being here. Highly recommend. He literally wrote the book on options, a brilliant guy. Be sure to visit his website at www.optionstrategist.com. And thanks so much, Larry, for being here. Appreciate it.
All right. Thanks for having me, Ken.
Hey, thanks, traders, for being here. We're lights at the end of the tunnel. We're almost done, and the vast majority you gave it, hundreds of you here today, so thanks for being here. Ratings that we out of 10 points go at 9, 10, 10, 10, 12, 8, 10, 10, 10. Yes, a lot of positive feedback, so I appreciate it. Thanks for being here, and I'm going to wrap things up if this all works properly. Let's see if I can get the presenter control turned over to myself, hopefully, and we'll be in good shape for my presentation. I'm having trouble switching back to myself. Unfortunately, that happens from time to time.
Would it help if I logged off or?
Yeah, sure. Yeah, go ahead. And thanks for being here. Appreciate it. That might do it. Thanks.
Okay. Hold on.
And thanks so much, traders, for being here. I do appreciate it. Okay, can you folks see my screen? Can somebody please let me know? I've got this big, complicated 5-monitor system, so. Hey, thanks, Rick. You guys can see. All right, well, let's get underway. Thanks so much for being here. And I am not going to show any PowerPoints other than all information is for educational use only. I'm a real money trader. Back when there was commissions, you can see I did as many as 5,000 trades in a single year. So I am a real money trader. You may have seen me everywhere. Let's jump into the charts. I promise we're just about done here. So one of the things that I wanted to cover for you is, first of all, let me ask, how many of you are swing traders? How many of you are day traders? And how many of you are both? Type in just quickly the letter S, D, or both, or type in swing or day or both, and I'll adjust my presentation based on the majority of what we're going to cover. Some of both, but I'll do more coverage on the charts that you guys are, most of you are both. Okay, thanks. Wow, like 90% are both. Okay, great. Okay, well, let's start off with swings and we'll flip into intraday. One of the things that I want to focus on is the types of charts that make sense to trade and volatility. And one of the best things that I want you to do is look for some of the strongest patterns out there where we've got sustainable trends. Let's take a look, for example, at the pot stocks. I live in Colorado, the $6 billion industry here. With a cannabis-friendly administration coming in, explosive moves to the upside are to be had. Now, I own every single one of these. Some of them are doing better than others, and a lot of them softened up yesterday, but last couple of days during the market drop. But let me blaze through these charts. You can see they all got high, bada bing, except some of them. ACB, here's one that I really like, GRWG, and I got this as a tip from Kramer, booyah. You mentioned this one on his Mad Money show, and it's something about the hydroponics and equipment to support the pot industry. So I'm going to start off for just a few minutes blazing through these charts to show you examples of charts you might want to consider up at new highs, so to speak. CRLBF, and I got these from a commentator on CNBC too, is some of the American-based ones, the 5-letter ones, CRLBF, wonderful chart. GTBIF. Again, I have no idea what the names of these companies are. I'm a trader. I don't care about the name of the company. Or it's forward earnings growth. I'm a price action trader. And CurlF. So those are some really good charts. Canopy Growth is the one that is widely highest respected and so forth. It's kind of the blue chip of the cannabis stocks, but it does not have a superior chart pattern. Instead, a better chart patterns to be had in things like this guy, the CurlF, GTBIF. The reason I'm bringing these charts to your attention is to illustrate for you the types of patterns that I like to trade. I like to trade things like cut patterns and ascending triangles and all the rest of the technical analysis 101 stuff. But mostly I like to scale in and scale out of positions once they're in play. And if you're looking at some of the high fly like our EV, like NEO, Harry had called this one earlier than I did. I called it at 16 or 17, something like that. Apparently he called it way earlier, but this is a really good explosive breakout, but it's pulling back. So obviously we would not want to stay long this. If we look at chart, if we take a look at the most recent price action runners, you can see Twitter's run up, social media's been hot, Twitter and Snapchat. I literally cannot believe Snapchat's at $52 a share, because I remember when it was in single digits, and now it's $54 a share. Boom. You could have made some money there, son, if you had potentially made a trade in that. Now, is the buying done? Well, not by this chart. It still looks like a breakout and continuation. Let me ask you a quick quiz question. If you were along Snapchat, which I am sadly not, but if you're along on a swing trade, where would you trail a stop? In training thousands of traders the last 21 years, one thing that I found is you guys screw up your stops. You guys let things go too far against you. Bad trader, don't do that. Your exits are much more important than your entries. And in my live trading room, I cover not only charts like this for swing and day trades, but the specific entries and exits. So type in a number right now. Where would you trail a stop if you were swing trading this? Don't everybody post at once. Say thanks, Nick. Below the second low, good call, Boz. Hey, DJ, 46, 47, 43, 25%. Okay, all respectable numbers, 47, 44, 44. Interesting. I would use a loss of the 50. Personally, you may have seen my stocks and commodities articles. I like to sell into 9 on the way up, and if I'm in on a new breakout, let's say about 51, 52, I'd stop out at say 49, maybe 48 at the lowest. That would be the correct exit. Actually, be 48, right under the 50, right under the 2 candle drop. Now, one thing that you may have seen in my stocks and commodities article, one of many that I post, is the whole when to get in and when to get out of positions. Here's a two-day chart of Snapchat. Thou shalt buy. It's my rule to myself. Of all the thousands of trades, millions of dollars worth of stocks and ETFs I trade, a breakout above the previous day's high. This would not be a buy because it closed under that. But when it ends the day, by the way, swing trading, you put on your trade in the morning is fine, or anytime during the day where it triggers. But what really counts from a trade management standpoint, this is the #1 takeaway for swing trading because I've tested it myself for years, and I'm very happy with the results. When the instrument you're trading closes at a 2-day high, which this is not, there's technical right in there, but if it closed up here, you would scale in a little bit right before 4 o'clock or add to your winning trade as long as it closes above the prior day's high. When it stays in the middle of the range, an end day, that's a hold. And when it closes the day under the previous day's low, you got to start scaling out. So for example, if this got down to 48, I'd scale out on it, okay? We got so many good charts to work with. One of the picks for my live room that I made yesterday was Virgin Galactic, and this for a day trade, really nice breakout. I called it long above the previous day's high, and I said to sell into the whole number. If you're a day trader, one thing I want you to always do is sell right under whole numbers. In my live room, I make live exit calls for traders. You know, I forgot where the long call was in this guy. It was right on the breakout here, but I said to sell into the 0.9 here. So if you're a day trader, at least lighten up or trail a stop because whole numbers often tend to act as reversal places. You have whole number support at 32, the mid-range at 33, and the resistance at 34. And you see these patterns over and over again in whatever you're trading. Whole number support and resistance. The previous speaker had mentioned DraftKings. Now that's a false breakout, so we don't want to take those. If you're looking for continuous breakouts, one of the things you want to look at is directional volatility for where it goes on the swing trading chart. So let's take a quick look. Now, did anyone else catch the bearish reversal pattern in the S&P? If we look at our S&P, you can see right here, this is a 90-day S&P. Thanks to Steve Nissen for teaching me this. This is a bearish reversal pattern. Now, this was a shooting star that got overcome, but just slightly, right? That's a sell signal if it loses there, but it came back to life, eventually grinding its way up to highs. But right here, we've got a bearish engulfment. So that's a sell signal under roughly 36.60. So we're still in a potentially bearish reversal territory unless we break above 37.10 or so. So always be on the lookout as markets testing new highs for reversal signals like shooting stars or bearish engulfings or tweezer tops. Let me ask y'all a quick question. Now, I've been on the wrong side of this, admittedly. I've been trying to buy inverse ETFs. I did really well back in February, March, and not so much since then. But I think this market is way the heck overbought, and I think we're due for the epic crash of a lifetime. And I think the biggest money I'm going to make in recent history is going to be shorting the market by going long in inverse instruments to go up when the market goes down. How many of you think that, how to say, yes, the market's overbought, and it may well keep going up higher, especially since the FDA passed the COVID, the Pfizer drug and so forth, and we're likely to get a stimulus package out at some point in time. So the market may still be good for a little bit more, but at some point in the near future, probably by end of January at the latest, we'll probably have at least a major pullback, if not an outright reversal. How many of you would agree with that the market is getting a little, I don't like the phrase toppy, but I think we are in overbought territory, and we may well see a dramatic, violent drop to the downside? How many of you would agree with that? I'm just curious. Now, admittedly, I mean, I screw up daily as well as make winning trades frequently. I've been on the wrong side of that argument for quite a few weeks. I've been thinking our inverse is like UVXY are going to bounce, but they have not yet. But they're starting to, right? This is the VIX E10. That's why I was asking Larry McMillan, because he's a total stone cold expert, the guy who knows more about the VIX than anyone I know in the world, looking for VIX bounce. And the VIX, you can see, look at the correlation between, here's the VIX, which you cannot trade, okay, but you can trade. I miss TVIX. I don't know if anyone misses TVIX. One of my traders, a smart guy, yesterday said TVIX used to be like a batshit crazy girlfriend sometimes. It's all over the place, but I miss those 7-point ranges in TVIX. I sold, let's see, let me show you some P&L proof here. If you want to be slightly impressed, real trade example, I bought TVIX at 50, I sold 940, near the exact freaking top, boom, before Credit Suisse delisted it. Much to my, I still miss TVIX like an old girlfriend because I nearly tripled the small account just to show you can do it. This is my Fidelity account. I bought TVIX at 50, I sold 940. That's the biggest point range win I've made in my life, and I will definitely never beat that. 890 points or something out of a single instrument. So that was good old TVIX. Anyway, UVXY, I'm looking for a big ass bounce in this guy. That's the lead indicator. By the way, bearish sentiment, you want to follow if you're a day trader, you've got to follow your VIX, and really critically, you've got to follow your ARMS index, the trend. And I learned about the trend from my longtime colleague, Tony Turner, who's brilliant, and her Beginner's Guide to Day Trading Online, highly recommend. The ARMS index was developed by Henry Arms back when I was born in 1964. I'm old as dirt, it feels like sometimes. Anyway, a trend over 1 it's an inverse indicator. When trend is over 1, it's bearish. I use 1.5 or higher as a bear indicator, or under 1 is bullish, and 0.7 or below is a strong bullish indicator. So this is a strong bearish indicator, and you can see we've got lots of volume in UVXY Wednesday, Thursday, Friday. Now I easily see a double or triple out of this guy. So remember I said that. It's funny, I was doing a presentation for Money Show on inverses on Wednesday, and I told everybody that Wednesday would be a good day for a breakout in SQQQ. And if we take a look at our 3-day, so we can see what the heck went on. You can see SQQQ had to short the NASDAQ. I did my presentation here to all the Money Show folks, and I said, watch SQQQ for a breakout over 16.5 later in the day, and boom, make it rain, baby. Boom, cha-ching, flawless victory. It ran up a full point. Now, Thursday was the most boring day in recent years, I think. Thursday was boring as heck, and yesterday wasn't too much better. But market volatility, be on the lookout for inverse instruments because they pop when the market drops, all right? That's what I trade virtually every day. Semiconductor inverse. Now, you may argue that semiconductor shorting is not smart. Permit me to disagree, to quote the great movie Kill Bill. I'm sorry, Pulp Fiction. Permit me to disagree. They've been shorting the heck out of the semiconductors. What's appealing to me on this chart is leverage. Behold, the power and the profit potential of buying a high volume pivot in something like SOXs. Now, I don't know that shorting semiconductors is particularly wise because it's been a rock star sector. You know, if you look at, say Micron or AMD or whatnot, you can see Micron's pulled up, broke out very sharply, but it's pulling back. So the trade is either you can buy puts in that and good luck with that, or I'm just going to buy me some, I'm going to scale in. I'm already in a little bit of SOXs, but this thing could really go up sharply because back during the March sell-off, it had been up at 460 split adjusted a share. Now on far sale, now this is still catch a falling knife. You look for pivots with high volume for confirmation, and particularly above moving average lines that institutional traders use. Now, one thing that I've learned the hard way is we always use the 50, 100, and 200 simple moving average line, but it's the 50 moving average often provides false signals. So use the 100. wait for something to get over the 100 on a pivot before buying it. Because here's UVXY, false breakout. UVXY, false breakout. But if it breaks the 100, say north of, I am going to wait for over 20 to start going long in UVXY on sides. That has really good directional volatility. Now, so that's my inverse playbook is, how to say, even if you just trade, directionally in your perma bull and you want to buy new things and all that kind of stuff, that's great. And that's worked out fine, of course. But always follow the UVXY as a critical. The UVXY and your trend are two critical market internals to pay attention to when you're looking for directional. Is the market going to go up or down? The UVXY acts as an extremely good lead indicator, even better than the E-mini. So it works really good. The UVXY because it's a volatility inverse indicator. And of course, if you're looking for nice breakout charts, whether you're looking for things like INO, I should say NEO, right? The other one, NEO, right? Or FCell. These are insane breakouts and they're very dangerous to trade. Now, these are not the kind of charts you swing trade. You do not swing trade at FCell. You day trade this because there's no consistency. What you want to swing trade, at least what I like to swing trade, is charts with more consistent trends like this. Hey, hit me with your questions. That's about all I got to say. I mean, I could go on for days, but that's the most important thing, valuable intel. Look for directional volatility in these charts. Let me give you another quick candlestick, momentum candlestick pattern that I like. And that's always small followed by large candles. If I can find one here, you see a small whole row body followed by a larger whole row body, and it takes out a horizontal resistance that often makes for a good uptrend continuation play. And if you're looking at, say, things like Tesla, you can see really good breakout, but starting to pull back. Some of these things are way overbought. So what you want to do is be cautious up here. Here's the pattern. Here's the magic pattern. Actually, the only magic is not in chart patterns. It's in risk management and trade management. Cycling in and out of your trades. But that's the pattern that I found to be one of the more consistent patterns. Now, this is a bullish engulfing. This is the classic candlestick reversal pattern. I just noticed that in OxyPete. And this is one I covered in my live room on Thursday for my members, and it worked out great. Anyway, this is a small followed by a large whole row body candle on increasing volume after a bullish engulfing pattern. But the main thing to look for is just simple directional, small followed by large. Baby bear, mama bear, papa bear, baby bear, papa bear, right? Small candle, large candle. And this kind of ties in nicely to what Dr. Barry Burns had said about low volatility versus high volatility. A lot of this stuff dovetails. When you learn from genuine experts, we tend to reinforce each other in terms of stuff we say, right? Unlike these moron millennials who are out there saying, let's day trade low float under $10 stocks and make $100,000 a day. How many of you actually believe these young kids who claim to be making $100,000 a day trading stocks under $10? I call bullshit. I think that's a bunch of hogwash. And fortunately, the FTC and the SEC has been cracking down on two of the biggest education firms, just got taken down. And I'm glad about that because they were bullshitting people making phony performance claims. Anyway, trading is tough and you got to do the tough work it takes to make trading easier. And the way you do that is look for repetitive patterns that have some degree of consistency and validity to them. So the small, large candle pattern is one that I've tested for years and one of my very favorite momentum setups. Now, also, when you're looking for exiting trades, how to know when to exit, I use the 2-day rule. So again, the trailing stop on this guy would be 19. If you're an OxyPete for a swing trade, I'd scale out if it loses 19 support. Again, not trading recommendations or advice, but just my own patterns. I also like to trade within decades. It's one of my favorite strategies, just like within whole numbers for day trades. For swing trades, I like to trade above a decade, a multiple of 10, like buy the 11, buy the 12, and sell the 18, 19. That's valuable. You should write that down. Remember that. I'm a price action trader, and I know how to trade. I mean, I'm the only educator I know in the world that bought TVIX at 50 and sold at frickin' 940. Boom. If you can find anyone else who makes $900 on a single, this is several months. I was swing trading just a few shares of this guy, but it was enough to over double this little account because I got it right. Anyway, hit me up with your questions, guys. What do we see? What do I think of the S&D? I'll chart. Hey, Aggie. Let's take a look at it. Trader's asking about a chart. Hit me up with your charts too if you want. Unfortunately, my co-presenters cannot see questions, but I could. So let's see. SNDL. Charts under $1 are crap and horrible. I would never trade that in a million years. That chart though, Twitter I like. Again, by the way, if capital is limited, folks, for the love of Pete, don't trade cheap ass stocks. They're pop and drop one hit wonders, and they are going to just. I've lost the most. I've traded millions of dollars worth of stocks. I know how to trade. Cheap stocks are cheap for a reason, like O'Neill would say in his book. What you want is consistency. You ain't going to get consistency out of cheap ass stocks. They are pop and drop, hot potato stocks. Who's going to be last holding the bag? And don't instead just trade lighter share size, right? You know, I'd much rather trade small size in a Twitter chart. Let's take a look at the chart example here. I'd rather trade, you know, say 100 shares of a $48 stock than 1,000 shares of a $4.80 stock for the same amount of capital, just because when they run, they tend to run hot and they tend to run further before they stall and drop. Also use things like the whole number resistance rule, right? If you say if you were to buy right above 51 for a day trade, you'd sell right under 52, say 51.8, or at least tighten up a trailing stop. Yeah, good point, JC, about TVIX. Too bad it wasn't in a big account. You're right. Yeah, story of my life. That's why I'm still a freaking educator, because I'm a chicken shit trader. I don't trade size. That's if anyone has any suggestions. If you've overcome, to me, $1,000, or I'm sorry, 1,000 shares is a big trade. To me, if I'm trading, you know, I start off my swing trades, by the way, under $1,000 worth of underlying. So, you know, if I were trading Twitter at a new high, I'd only buy like 20 shares of it. And then if it works out, I'll martingale in. I scale in every few points. And for all the times that it doesn't work out, it doesn't cost me much and bite me in the ass. So that's why I trade small size. But that's my number one failure as a trader is I failed to get comfortable trading large size. And if anyone has any suggestions on how to get over that and trade large size, I've heard some of Wall Street's top coaches and they say, think of it like units or think of it like you're trading chips, but I can't. In a casino, I always think about the dollar. So I trade small size, I get it. One of the goals is to scale in position size into winning trades sooner rather than later. And you're looking for charts that have really good directional volatility that are worth taking a ride on, right? By the way, IPOs are usually horrible to trade. So, I mean, could you have day traded this successfully? I don't know. I called the long yesterday at 146, I believe it was, and I said to sell to 150, right? I use whole numbers. I made a winning call for my members, but in general, I don't like these kind of charts. I prefer charts that go in stronger directional moves like this. Really good play. GLSI, is it going up again? I'm not going to touch I didn't trade GLSI because it didn't break till late in the afternoon and I just trade the open. But more importantly, it was halted like 4 times. So I don't like things that have so much volatility that they halt. Hey, Nick, how about the Qs? I used to trade T triple Q. Now I'm looking for plays in shorting the Qs with S triple Q on any strength. So this is an uptrending chart. Am I right? This is the short Qs. This is how to short the stock market. I'm long this position, though reluctantly, because it didn't end up in a nice place yesterday. It gapped up, it pulled back, it ran up, then it ran back down again. But it's still in a technical uptrend. I'll start to scale out of my SQs position on a swing if it loses 16.8, and I'll capitulate and go to cash if it gets down here in the low 16s. I'll scale in if it breaks over the whole number over 18, like say 1810, 1820, I'll scale into it. But the one thing I want you guys to pay careful attention to is UVXY. It's especially important because that is volatility, and that's a bearish indication, right? And I'm long this a couple hundred shares. I'm not in size yet, but I want to scale in if it breaks 1260 or so. And again, in pursuit of more money. I'm always trying to trade, make more money. So I'm gonna wrap up here in a few minutes. This thing, again, it's starting to get a pivot. And if you look on the 6-month or the 1-year chart, let's take a look at the 1-year. Last time the market sold off. Now here's another quick tip, having been the guy who sold TVIX at in case you're curious, I'm not saying this to brag, I'm saying it to try and illustrate for you guys the importance of exiting sooner rather than later, and always position size and scale. Never do all or nothing trading. I sold 940, all right? I sold 940. My best exit in my life as a trader, because I bought at 50 and I sold at 940. I'm proud of that. I'm just sad that this thing isn't trading anymore, but hey, c'est la vie. I think somebody's coming out with some alternate VIX instruments, but for now, I'm trading with UVXY because this is my #1 pick for an oversold is going to bounce play ever, right? So UVXY, I really believe that it's especially if, like Larry says, if the S&P gets under something like 3,550, or if the VIX breaks over the 200 SMA, especially long UVXY, if it breaks its 200 SMA over 30, right? So for the fellow would-be bears, if the market does drop, this is going to be the first play of the day, and shorting weakness in things like semiconductors with our SOX's chart, which is also, it had a pretty good day Thursday, Friday. It's been in an uptrend as well. So this is the case for bearish reversals, is these are all inverse instruments that are leveraged, and they're not for new traders. They have contango and price decay, so you don't want to hold on to them for a month or anything. But for a several week swing trade, they can potentially do very well during times of market downturn. So remember that. A good point. A trader is saying if they traded Amazon earlier, it'd be worth a lot here. Let's see. Nick's asking, Fidelity doesn't allow, well, allows me to trade it. I'm with Fidelity. I trade UVXY and SOXs and all that. I trade UVXY nearly daily lately, and you have to. By the way, before trading inverse instruments, you do have to verbally like sign an okay with the broker, acknowledging that you realize that they're dangerous and they're high risk and all that kind of stuff. So it's proceed with caution, but they are really good setups for good strong breakouts. Anyway, I'm going to buy me some more SOXs over 20.7 if it pops up there later. By the way, just it's very fascinating. You can see relative strength or weakness in markets based on the inverse story. The SQs were down. Dow, the short Dow, was down the most yesterday. But it's still in an uptrend, though a uncomfortable uptrend. The strongest uptrend is shorting technology with the SOXs and going long volatility with UVXY. And that's the best of the inverse charts, obviously up 2% from the open on Friday. And yeah, JC is saying UVXY can go up 10 times and then some if the market freaks out next year. Yeah. Hey Nick, yeah, I trade UVXY daily in my Fidelity account, so you can trade it. You have my word on it. I could show you trade executions if I opened up my Fidelity account, but yeah, I trade UVXY daily in my Fidelity account. Anyway, really good charts. Now let's wrap up here today. My time is at a close. It's been fun. I wanted to thank all of you for being here, and hopefully you've learned some useful intel from my traders and my guests. And as traders, I wanted to thank all of you for taking time out of your undoubtedly busy holiday schedules to trade here in the middle of our global pandemic. But anyway, US-based pot stocks, probably a good sector to go in. Electric vehicles, probably overcooked for now, but if they do take out new highs, continue in them. Return to normalcy plays. You know, I was trading MGM from $7 a share. Unfortunately, I only sold at 8 and I didn't hold it. I wasn't patient enough. But things like DraftKings and MGM and Caesars and Wynn and Las Vegas Sands are casino stocks. I don't know if Carnival Cruise Lines and Delta Airlines and all those are going to keep going up. Personally, I'd be looking for plays in pot stocks and inverse instruments are my two key sector. I can't make recommendations, but it's where I put most of my capital is things like this, the pot stock, the cannabis, US-based cannabis stocks, and also our inverse instruments. Maybe worth taking a shot at bottom fishing here. And for more, let's see. You can try my room at tradingtheopen.com. Let me pull this up for you. In my live room, we go over specific entries and exits. And let me find the slide here for you. I don't use PowerPoint much anymore. We meet 5 days a week from 9 o'clock till 10:30, and I give my traders specific entry signals, and you can join for just $7. Money back guarantee. If you don't like it, I'll give you $7 back. I've had like 3 people take me up on that out of hundreds over the last many years. Anyway, but 3-week trial, just $7, PayPal or Visa, MasterCard at tradingopen.com. And I've also got an annual membership available at just, what, $9.97 for the year. So that'll wrap us up for today. I wanted to thank all of you for being here. And let me see if there's any last questions. A lot of you have been asking about recording, and yes, if it works out, I will get the recording out to you guys sometime within the next day or two. One thing I wanted to mention, and this is something that separates my live room, I've ran Trading Open since the year 2000, so I've ran it for 20 years now. Thousands of people trained, I should say, in how to look for their trade setups each day. One of the things that I do for everybody is have what's called an answer key. Let me see if I can get this loaded. And we're about going to wrap up here. Okay, this is the answer key from Friday. What I cover for traders is real-time entry signals as well as where to exit trades. So each morning before 9 o'clock even, traders get the specific list of tickers, usually 5 to 7, maybe as much as 10. Traders will ask me about charts, and so I make live room calls for them. But it's kind of what I thought would be kind of clever. It's just a Word document, and I update it each morning for my traders with a watch list. We start off with 5 or 6, maybe 7 stocks, and then traders will ask me about charts of their choice, and I always, if they look good, I'll go ahead and pull that up and give people specific entries, both long and short triggers, as well as what to trade and how to trade it. So thank you so much for being here, people. I appreciate it. UVXY, I've been scaling in and out of it, kind of threading the eye of the needle, but you buy the dip, sell the rip in that one. So any inverse instruments, as you can see by history, when they spike up, you start to use trailing stops. And Larry mentioned this too, and it's critically important. And I think Barry too. Always use trailing stops when you're trading volatile instruments. And so anyway, it'd be my honor to have you guys in my live room. And I wanted to thank you all for learning, hopefully, from I learned a lot from all the speakers today. Unlike a lot of the multi-speaker events, I only do these shindigs once or twice a year. Would you guys like to see another one of these with these speakers, or maybe these folks and maybe a couple others, maybe in January or February? How many of you would like to see me repeat this more than once a year? I'm not going to do them as often as my colleagues who do a lot of multi-speaker events do. I don't have the energy, frankly. I'm 56 years old, almost 57, and but I do like to provide value to the trading community and do it in a short 30-minute, short and sweet, to the point. It's like, get on with it already. They give you your top tips. And that's why I get everyone to do 30-minute events, and I only invite the world's top people that I trust and I believe in. I think they can really be part of the solution instead of part of the problem, like so many of the other educators are. And hopefully it'll be good value to everybody. So hey, thanks. Yeah, Drew saying maybe do 1 a quarter. Yeah, that's my goal. That makes sense. Great speakers. Hey, Nick, saying very nice, being short and sweet. I enjoyed it. Nice format. 2 a year is good. Yeah, maybe 2 a year, 2 or 3 a year. I'd love to see another summit. All right. Yes, brilliant. Do it again. Yes, please set up. I'm reading off comments. Yes, please set up more of these. Hundreds of you folks here. Appreciate it. Allow 5-minute breaks hourly. That's an idea. Hey, Rajendra, you're welcome. Thanks. All right. Sounds like everybody's on board. So y'all take care, and I will see you in our next event. Stay safe out there, right? The light's at the end of the tunnel, and hopefully we'll all get through this pandemic in one piece. And wanted to wish you the best for trading smart in your own trade. So take care, and thank you so much for being here. Bye for now. It was a good day. I'm proud of you folks and my traders, and I'm glad it all went off smoothly. So thank you for being here. It means a lot to me. I don't have energy to do these too often, but once or twice a year, they make sense, right? So see you guys next time.